Good morning and welcome to the Maryland Public Service Commission. We are on the record in case number 9648, which is the EmPOWER plans for the years 2021 through 2023 program cycle. Today we have four distinct parts on our agenda. We're going to begin with a review of the cost recovery work group's report, followed by two presentations by program administrators, starting with Potomac Edison and then moving to Washington Gas Light Company. Each of those companies will have an hour and a half to make their presentations. And then we're going to conclude the day with general and industry comments that were filed by about 12 parties. Before we begin today's hearing, are there any preliminary matters that parties would like to address? Hearing none, we received the work group's report on cost recovery on August 14th of this year. Shortly thereafter, we received a protest that was filed by the joint utilities in response to allegations that Office of People's Counsel filed some of its information rather late. So I suspect we'll hear about that at some point. And I recognize that staff has made an expedited request for certain information that we could discuss at the appropriate point in this hearing. With that, I'll turn to staff to begin its presentation. Good morning.
Good morning, Mr. Chairman and Commissioners. This is Dan Hurley with the Commission staff, and with me this morning is Ben Baker. And Ben will be giving the presentation, and we are both available for questions as they come up. Thank you.
Good morning, Chairman and Commissioners. This is Benjamin Baker on behalf of staff. So yes, today we're going to cover the items discussed within the work group report regarding cost recovery. There were 5 items that were generally discussed within the work group, and then I'm going to bend it into 3 different subject areas to lead the discussion. So the 5 items were: what is the appropriate rate of return for the unamortized balance that we currently pay, that's currently in the state? Should we pay down that unamortized balance, and how should it be paid down? The next one would then be, we discuss PEMs, so performance enhancement mechanisms, and we discuss possible structures and possible proposals. We also, in this forum, discussed what to do with the over collection due to COVID and what could be a possible solution. And finally, we didn't really spend too much time discussing it, but there was a little bit of discussion regarding third-party participation, but that was more informational in nature and would need to be discussed further. So really the 3 groupings of items that need to be discussed as a group or commission decisions will be needed on are: what should be done with the unamortized balance, what should happen with PEMs, and what should be done with the overcollection due to COVID-19. And so just a quick summary of what staff's position is on these different things. Staff is still proposing that the rate of return for the unamortized balance be the utility's weighted average cost of capital. This is OPC, though, has a different view of this, and I will let them just explain their position. We also would support tentatively amortizing the behavioral and utility administrative expenses in over 1 year instead of the 5 years that is currently done. But we only received surcharge proposals from 2 of the utilities regarding this, and we're going to request by the next surcharge filing that those be filed for final commission consideration. Staff would propose rejection of the utilities PEM at this time. And we would also propose that in the 2021 surcharge filings is the appropriate forum to determine what to do with the COVID-19 imbalances. So with that stated, I'm going to hop into the first big issue, which is what to do with the unamortized balances. The different proposals that were considered to basically lower the cost to customers or to get rid of the unamortized balance in its entirety were: 1, lower the utilities rate of return on the unamortized balance; to expense part of or expense the entire EmPOWER program. And then 3, MEA was considering proposing some PIMs that would eventually lead to expensing of the entire EmPOWER program. I'll let Kitson speak more to that, but I believe at this time that they are not proposing any PIMs for this planning cycle. So with that, I'll let OPC go into their position on the ROR, but staff's view of it is that the unamortized balance should continue to earn the weighted average cost of capital. This is traditionally how the return that utilities receive for costs that are amortized over multiple years. If we allow different recovery of these, you're putting the energy efficiency programs on a different footing relative to the other distribution investments. And then finally, the weighted average cost of capital is the agreed upon return that comes out of a rate case that's litigated with the commission. And we don't typically tell our utilities how to finance their various programs. So it's really, here is your cost of capital to finance your entire operations, go forth and run your programs. So with that, and then the other proposal on the other side of that was I'll stop there and I'll let OPC go into their ROR discussion before we move on further.
Do we have counsel for Office of People's Counsel?
Good morning, Mr. Chairman, Commissioners. This is Philip Sheehan on behalf of the Office of People's Counsel. We have also a presentation that we put together with the EIC that discusses these issues, a short presentation. So we weren't anticipating jumping in and out. If you do want us to address this issue here, I would ask our consultant, Dylan Voorhees from VEIC, to address that issue.
Thank you. Mr. Baker, should we just continue with your presentation and then?
Yeah, that might be cleanest. So I'll just finish with the presentation on the unamortized balances. So then the other half of the unamortized balance issue that we're looking at is, should we continue collecting the entire an unamortized balance over 5 years, which is effectively a rolling 5-year loan? The work group has come to general agreement that the cost recovery of the behavioral programs in 1 year is appropriate, and the utilities have also offered that their administrative costs would be expensed in 1 year as well. So and I think most parties are in general agreement with that. We'll hear today. Staff has previously presented analysis to the commission regarding complete transition to a 1-year cost recovery model, but to do so in a short period of time is a very expensive proposition due to the increase in rates. But the only way that we're ever going to get rid of this unamortized balance is to pay it off. So OPC has proposed to lower the cost of debt as one way of lowering the cost of this unamortized balance, but that would not get rid of it. Alternatively, we could transition to an expensing model, but we could consider some of the items that were discussed within the work group were, instead of using a 5-year unamortized balance to pay down this expensing proposal, it was to expand the amortization of the current balance over a greater period and go transition to a full expensing model. But one of the biggest issues with that proposal is now we're getting into intergenerational payment concerns, where customers possibly 10 years down the line are paying for programs from 10 years before, just so we could basically avoid having a painful rate increase now. The anticipated impacts of switching to a proposal where we're only expensing part of the programs, looking at behavioral administrative cost. Only 2 of our utilities at this time have provided the rate impacts for, or not rate impacts, but the surcharge impacts of those proposals. And staff put together some tables on page 17 and 18 of our comments if you want to walk through those at any point today. But I should note that any proposal to expense any of these programs in the short run will lead to higher rates over the next couple of years until the unamortized balance that's currently sitting in has not currently been paid off, is paid off over the next 5 years. And so we won't really see a rate reduction from these until we get out till probably likely 2026. With that stated, though, once we see an initial large jump in the first year, the following years we'll see less increase. We'll see a smaller percentage increase in the surcharge, but the first year of us of expensing will be a larger impact to rates. And so our recommendations regarding expensing, we would support transitioning to an expensing the behavioral and administrative costs, but we would request that the utilities who have not provided the surcharges yet do so in their 2021 surcharge filing, so the commission can make a decision with all the information at that time. And this is also, we believe, important because we need to weigh the switching to this model against the increase in bills during the COVID-19 crisis. With that, I can stop there and turn it over to you.
Thank you, Mr. Baker. On your last point with respect to the 2021 surcharge filings that are coming due, when are they due to the commission?
I believe in the next couple weeks, Dan.
Okay. I think you're correct.
Yes, Mr. Chairman, the surcharges usually go into effect the 1st of January of the following year, and we usually see those mid to late November. So we have our time to review the filings and submit our comments to the commission.
Thank you. Just fair warning to 4 utilities, because I'll be asking the 4 utilities in a bit. They include BGE, Delmarva, Pepco, and SMECO, whether or not they'll be able to provide this information on the projected surcharges for the behavioral and administrative amortization to the commission within about 2 weeks. So I will save those questions for the utilities. Do the commissioners have questions at staff at this time, or would you prefer to hear from the others first?
Mr. Chairman?
Hi, good morning. Commissioner.
Mike Richard, yeah. Mr. Hurley, as I recall, and if I'm wrong, tell me right away, but didn't staff do a study several years ago where they looked at other states' energy efficiency programs and then looked how the both the recovery but also the rate of returns were calculated? Did staff conduct that research?
Yes, we did that. We included that research in our last comments on the 2018 to 2021 program plans, and that kind of led to the initial cost recovery work group work. And that kind of led staff to, as we proposed about a year ago, we had that kind of a step down the amortization process from 5 years to 4 years down to 1 year to go with expensing. At that time, a majority of programs in the country were using the expensing model, where we were still on the 5-year model, and that was kind of our way to propose stepping down to go to an expensing model. If you may recall, it did lead to very large surcharge increases as we move to the expensing model. It's kind of that balance of we're lowering the unamortized balance versus the higher rates for several years until things come into balance.
Okay. Also, can you help me recall, was there also a finding that there was a difference in the returns provided to utilities of those other states for their energy efficiency programs, or do they also just use the authorized rates of return?
Most of the states, when you're looking at amortization type recovery, are looking at the authorized rate of returns as the rate of recovery. If you're expensing, you're really not seeing the need to have, you're not carrying large balances of unamortized costs that need to earn a return.
Oh, okay. And just, we'll be hearing shortly from OPC, but in some of their arguments about a lower return, they talk about this is a lower risk, this is a mandated program, and the revenues or the revenues are coming from utility or from ratepayers directly. Did that factor into any of your considerations when you were making your rate of return versus another return?
So we factored it into the return in our analysis, but kind of based on what we presented in our presentation, we look back at trying to determine an appropriate rate of return, and it really came back to the utilities weighted average cost of capital, primarily for the two reasons we stated, that it keeps the energy efficiency cost on par with other investments in the utility. And also it's a commission determination. It happens to a rate case. There's testimony and cross-examination, so all the parties have a chance to present the commission with their opinions on what the appropriate rate of return is, and the commission makes that ultimate decision.
Okay. How about the decoupling policy? Should we as commissioners consider that, the fact that utilities are made whole even with reduced electric sales due to energy efficiency?
Yeah, so I think that the coupling is just kind of a way, when it was set into place, it's kind of a way to eliminate that throughput issue where utilities were making more revenue the more energy they sold, due to the fact that some of the fixed costs of the utility aren't always in that fixed customer charge. They're collected in the variable charge. And to promote energy efficiency, the utilities would be losing revenue based on the throughput issue. But with the BSA, it kind of keeps them whole on their distribution side. And then you're going to see the customer savings for reduced usage really be more in their supply side, where they'd be using less energy and paying less for their supply.
Okay, so you don't see any way that decoupling should be considered as an offset or an argument why there should be a lower return rate for energy efficiency programs like EmPOWER?
Not at this time, no.
Okay, thank you. Thank you, Mr. Chairman.
I can't see other commissioners at this point. Let us move to Office of People's Counsel.
Sorry, I had a question.
Oh, sorry, Commissioner. And if we don't need the presentation, if we could bring the slides down at this point. Thank you.
So, Mr. Baker, I'm looking at your slide, your pages, I think it was 17 and 18 of your comments.
Yes, I'm pulling them up.
Okay.
I'm there.
All right, I just want to understand, when you say dollar change, that is that the total surcharge, or is that the additional? I mean, like, if we kept it, I'm looking at the PE one, Potomac Edison. I'm looking at the top of that table 15. If it says dollar change, you have 5-year amortization in 2023 is $1.57. So that's if we did nothing, it would be $1.57. Is that right?
And yes, relative to 2021.
Okay.
Sure.
Well, I'm not sure I understand.
Relative to 2020, my bad. My apologies.
Oh, okay.
So,
but that would happen no matter what, right? If we change
correct.
nothing, that's what would happen.
If you change nothing, that's what would happen. The next one is if you only go to expensing of the behavioral programs, what would happen? And if you expense both the behavioral and the admin, that the final line would be of 189 is what would happen relative to 2020. So this isn't really showing the year-over-year change. This is just showing the change relative to where we are today.
Okay, so if I'm looking at the 2023 column, if we kept everything the same, it would cost $1.57. If we added the behavior, it's 21 cents more a month. Is that right?
Yes.
And then so on, it's what, 32 cents more for behavior plus administration.
Correct. And this is, yes. And I would argue you're seeing a similar impact on the C&I customers, though they are taking a larger impact to their beginning surcharge in general. So this is something I was planning on discussing more on Thursday, but the C&I customers are taking a large increase in their surcharges over the next couple of years based off of the program designs. So that's the residential class, yes, that we need to worry about them too, but it's actually the C&I customers who are taking a larger percentage increase inside their surcharges. But
Okay,
you'll see the
right.
same thing in their following table as well, though.
Right, okay. So I guess the dollar change was a little, when I read it, it's like the difference between status quo and making the change. That's not what's being reflected here, other than doing the little bit of math that we just did.
In between, yes. I was trying to find an easy way of showing this, but there was not really a clean way of showing all these different variations.
Oh, that's okay. I just wanted to make sure I understood it. So now I'm looking at page 21 of the MEA Oculus report. Can you pull that up?
Yes, give me 1 minute. Nope, that's not the Oculus, that's the other one. Okay, page 21.
Yes.
Okay, I'm there.
Okay. So help me understand this table, because it's kind of like combined for all utilities. So how would we?
Sorry.
Help me understand this one.
Right. Kitson will probably be a more appropriate person to explain this, but my understanding of this table is that this is showing proposals that we were studying a couple years ago. So the PSC, this isn't really discussing amortization of one program. This is discussing expensing of, trying to transition us to expensing of the entire portfolio and trying to look at the different paths that we could follow. And so this is where what MEA was trying to do was develop different approaches by which we could pay down the unamortized balance to zero without taking large impacts to rates. And so what Kitson and team were trying to show in this table, to my understanding, was the analysis Dan was discussing earlier with Commissioner Richards, was we had gone through a process by which we were looking at what if we amortize over the next couple. We basically stepped down the amortization over the next couple of years, but at a certain point within that, there was a large rate increase such that we were collecting an incremental $15 a month out of that surcharge, versus some of the other proposals that were being discussed within the work group would not have resulted in that, but they were also extending the amortization of the balance past the 5 years that we currently have in place today. And also, I believe, like the OPC proposal was looking at, what if we just use a lower ROR? So this table was trying to capture, I believe, those different.
Okay, I just wanted to, so this isn't your proposal?
No.
Okay, that's what I was a little confused by that, and I just wanted to make sure. And then, Dr. McNeil, I have to say, I thought your reports were really helpful on this subject matter, so thank you very much, and I'm sure we'll get to you, and I have other questions, but I just wanted to make sure that I understood that this wasn't the current staff proposal.
No.
Okay. So I think that's all I had. Thank you, Mr. Chairman.
Okay, we'll proceed to Office of People's Counsel, MEA, followed by the utilities, and then perhaps we could have a more lively discussion with all the commissioners' questions for those parties. So we'll turn back to Mr. Shaheen.
Good morning again, Mr. Chairman, Commissioners. OPC's conclusions and recommendations on the cost recovery work group issues are detailed in the final work group report. OPC looked at the issue of the unamortized balance from the surcharge payers' perspective. And we tried to reduce the burden on surcharge payers, which at this point is approaching 15 to 20% of the surcharge amount paid is just to service the interest on the unamortized balance. We also wanted to ensure the utilities return was fair, and we presented to the work group various scenarios of keeping the current rate of return, which is weighted average cost of capital grossed up for taxes and is quite high, to a fair rate of return. And we also looked at different time periods for phasing into complete expensing, and then also the issue of making payments toward the balance. We looked at those. So I'm going to turn it over to BEIC, our consultant, Dylan Voorhees. Also, David Hill is on the line, and he did a lot of work on this and is available for questions. Thank you.
Mr. Chairman and Commissioners, my name is Dylan Voorhees. I'm with BEIC, and I'm going to attempt to share some slides now. Okay, hopefully you can see my slides in a normal display view. And hopefully you can hear me.
Yes, we can. Please proceed.
Okay, thank you. So I want to start with some framing. Slide. Some framing issues. So following Mr. Shaheen, we conclude that the status quo is unnecessarily burdensome. As you stated, over 15% of the total annual budget is going to carrying costs. The total balance has grown to nearly 800 million at the start of this year, with an annual carrying cost of $53 million. And so although EmPOWER remains highly beneficial for ratepayers, and we want to stress that heavily, those carrying costs create a burden that can and should be reduced through fair adjustments to utility earnings. We believe that utilities ought to earn a return for costs that they incur, and that return should be commensurate with the type of investment, the level of risk, and outcomes. The phrase has been used that the rate of return should put energy efficiency on a level playing field with other investments. And that's an appealing concept. We think if you step down a level, you find that, in fact, there are different types of investments, different levels of risks, and important differences in outcomes. For example, whether or not a utility owns equipment could be a meaningful distinction about the type of investment and the rate of return. And I'll come back to that. But I want to point out, and there was a question about this earlier, because it amortizes energy efficiency program costs, Maryland is an outlier among leading energy efficiency states. And Maryland clearly is a leading energy efficiency state, and also an anomaly for providing utilities with such a favorable return year after year that is not related directly to their performance. As I said, it's really important to recognize EmPOWER has been a success, and the Commission has recognized both EmPOWER's success and a concern with the ratepayer costs of carrying a large unamortized balance, and that was, of course, the direction behind the current work group. EmPOWER utilities have achieved very significant levels of savings, and the gross annual savings of 2% of sales has put Maryland squarely in the top 10 of states as ranked nationally. And we recognize that multiple factors have contributed to this success. And without putting a quantitative judgment behind each of these, here are some of the things that have contributed to that success. One of which is the clear statutory and regulatory framework requiring, so-called requiring, a 2% savings. That's contributed to the success achieved to date. Also, the ongoing collaboration and advocacy and support of strong programs and the receptivity on the part of the utilities as program administrators has also clearly contributed to that success. And I recognize the ability of utilities to earn some return on the required level of spending has also contributed to the success achieved to date. However, it's a good time for EmPOWER to reach a better equilibrium point. So the analysis and recommendations stemming from those, the scenarios that were presented focused on the Rider 2 residential portion of the balance. That is only a portion of the balance, and use the amount from Baltimore Gas and Electric to illustrate the costs and benefits of different options. And I'll explain that, and it's detailed in the report as well. So for BG&E, that amount is $130 million, the Rider 2 residential portion, out of the full balance identified by MEA for BGE of $330 million. So I just want to be clear that we're talking about a subset of that in order to illustrate different options. So it is illustrative. It's based on the best information that we had available at the working group. And BG&E agreed that an initial nominal analysis fairly represented the surcharge impact of pay down and interest rate scenarios. And I'll come back to that point in a moment. Really important point, using these numbers, OPC focused on the net present value of different options. The actual rate setting is a more complicated matter. It remains the responsibility of utilities under commission oversight. We're not trying to take that responsibility on, but focusing on the net present value gives an important lens on the economics, pros and cons. Using that framework, we find that reducing the rate of return and or paying down the unamortized balance have the largest net benefits. So starting with the rate of return, first of all, reducing the rate of return on the unamortized balance is the simplest, most direct, and immediate way to attain the Commission's objective of reducing ratepayer impacts and the long-term costs. There's discussed in more detail in the report. Such an approach is justified given the risk of the debt and equity portions of the capitalization. And so as an alternative to the weighted average cost of capital, OPC recommends the Commission consider a rate of return that's more aligned with a secure long-term debt return. So the 20-year T-bond rate, the average over time of that bond rate is about 4.5%. It's currently much lower than that, but that's a long-term average of where that long-term secure long-term debt rate is. And the A-rated utility bond rates are a little bit more than that, typically about 2% more than those T-bonds. And therefore, OPC respectfully recommends that the Commission consider a rate of return of approximately 6.5%, or about 2% over that long-term average of the 20-year T-bond rate. Looking at that BGE residential example, making this single change would save ratepayers about $24 million over 10 years and allow utilities to still earn a significant return. Answer questions about that, but we'll move on to the other alternative of paying down the balance. So this is a slower process than simply changing the rate of return, and it requires a more complex analysis, but obviously is something that we think should be seriously considered. Determining the best option for paying down that balance hinges largely on how you think about the time value of money, the discount rate at which we value future savings or costs compared to those in the future. And that is a determination that ultimately rests with the Commission to determine which discount rate reflects what we would generally call a social discount rate of how folks in Maryland will feel about the value of benefits in the current time versus in the future. And the conclusion that an analysis reached was that if the ratepayer's real discount rate is 5% or less, then they will pay less in present value terms if the unamortized balance is paid down over time. And that's not a judgment, that's an economic conclusion. If the discount rate is significantly higher than that, it is not in the ratepayer's interest in terms of the present value to pay down that balance. We would point out that many jurisdictions use a social discount rate of 2.5% to 4% in real terms, including this commission has ordered a 3% real social discount rate in the EmPOWER social cost test. So concluding that the discount rate is at 5% or less is not unreasonable, but really that determination makes a big difference on the benefits of paying down the balance over time. Just give a moment of an example of what the OPC looked at. This example shows a 10-year pay down using that $130 million BG balance with an assumption of a 5% discount rate. So the first column, first two columns show the revenue requirement, which is abbreviated RevRec or RR on this table, under the status quo in the first column or under a 10-year pay down. Those are obviously in millions of dollars. So $61 million in year one, $74 million in year one under a 10-year pay down. The bottom lines of this table show the present value of those revenue requirements. And this is where it's important as you make changes over time to look at the present value, and that's where that discount rate comes in. The present value calculation for the status quo includes a present value estimation for the fact that at the end of that 10 years, there's still an outstanding balance of $130 million, and that needs to be factored in to make an apples-to-apples comparison to the paydown scenario. And as you see at the very bottom, the present value of those two scenarios is $613 million of revenue requirement under the status quo and $599 million or $14 million less under the paydown. The colored bars in this table show the change in the surcharge that would be required to pay down that balance using this example. So in the first column, this is the change in monthly surcharge for typical residential customers, starting out 77 cents additional surcharge per month. That surcharge would that increase surcharge would decrease over time and ultimately be lower, result in a lower surcharge over time after the balance was paid down, because ratepayers would not be carrying the cost of that balance. The column on the right shows that that surcharge, monthly surcharge increase in percentage terms. And this is where I think there was some disagreement about the proper way to evaluate that surcharge increase on a percentage term. Of course, there are multiple ways, different denominators you could choose to illustrate that surcharge impact. And the utilities can speak to what they think is an appropriate way to estimate that increase. We believed, and so indicated, a surcharge increase as a percentage of the total surcharge, the total EmPOWER surcharge. So we thought that was the most useful measure of this in percentage terms, is to say what would this do to the total EmPOWER surcharge. But I would draw your attention perhaps mostly to the actual dollar amounts. Those are the actual amounts of this, the surcharge would change under this example. And over time, a small surcharge impact is reasonable to consider in pursuit of lower total costs. And we just point out that's not unlike the concept of EmPOWER itself, which is to pay a small amount in a surcharge in order to get a larger total benefit. Briefly on expensing, phasing EmPOWER to expensing, cost recovery, so there's a typo there, should be considered, and it's implied in the strategy to pay down the balance and not simply build it back up again. We do caution that moving small portions of EmPOWER costs to a different model of cost recovery in the absence of a comprehensive strategy adds a lot of complexity. This situation, how cost recovery works in Maryland is already very complex, as the working group found and has found over a long time looking at this issue. Having two different modes of cost recovery adds that complexity. That said, and as Mr. Baker suggested, the case for expensing administrative and behavioral costs is, I think, especially clear, but would reiterate that most states use an expensing method for cost recovery for energy efficiency programs overall. And the last slide I have is on performance incentive mechanisms. The work group did not really have significant time to consider this very complex issue of performance incentives. There was some useful starting conversation. In the broader context, we just recognize that EmPOWER is, as you know, reaching the end of its authorization in the coming cycle, which makes this a useful time to step back and consider goals and metrics. And we look forward to talking about that as the week progresses. With regard to PIMS, we believe a detailed investigation is needed and should include, at a minimum, whether a performance incentive is needed and what additional benefits that might provide, which metrics would be appropriate, and there are multiple choices, and in many cases, a combination of metrics is used. And lastly, how any potential utility incentive could either advance policy goals or potentially distort EmPOWER results. And there needs to be some diligence done on how those PIMs would impact utility decision making. Therefore, we strongly recommend that performance incentives only be considered in conjunction with an examination of overall EmPOWER goals and alongside other relevant proceedings, such as the one at Public Conference 51, also looking at performance incentives, and these issues should be considered together. So thank you for listening to those remarks. I'm happy to answer questions. As Mr. Sheehan said, Mr. Hills, we're with me as well. Should that be helpful? And I don't know if I might have missed something, if Mr. Hills has any comments to add before I open it up to questions, but I will stop sharing my screen in any case.
Thank you, Mr. Voorhees. We've lost your video, but we hear you just fine. Do commissioners have questions now, or would they like to reserve? Commissioner O'Donnell.
I wanted to briefly, Mr. Chairman, ask the BEIC if they considered a combination of a reduction in the rate of return and a pay down, some kind of hybrid combination instead of one or the other.
Thank you, Commissioner, for asking that question. I'm glad you did. It is possible to consider both of those together. The changing the rate of return, however, changes the economic analysis about whether or not paying down the balance over a certain period is in the ratepayer's interest. If the rate of return was lowered to a very low level, then it might not be as attractive to pay down that balance. I don't know if you follow that. So there is a dynamic relationship between the two, and you certainly can find a point a partial lowering of the rate of return where paying down the balance over a 10-year period might be beneficial. But you have to do some dynamic math to look at those together.
I suspected that was the case, and I really was asking, had you done that? Had you found that balance point?
So at the rate of return that is recommended of 6.5%, it becomes a closer call on the present value calculation of paying down the balance. And that determination of what the discount rate becomes very important and very sensitive to that point. So for example, if it is 3% versus 4%, you might get a different outcome. So we have a model and a framework for considering that input of what the social discount rate is a very important sensitivity, and the commission might want to make a judgment about what the discount rate would be in order to make that that calculation useful to you.
Thank you, Mr. Voorhees. I appreciate it. Thank you, Mr. Chairman.
Thank you. We'll next turn to representatives from the Maryland Energy Administration. Dr. McNeil, good morning.
Good morning, Chairman. Good morning, Commissioners. For the record, I'm Kitson McNeil, Policy Manager, Maryland Energy Administration. I will make some brief comments regarding the testimony that was, well, I'm not testimony, I'm sorry, the comments that were filed in the work group report. And I'd like to also add that we are scheduled on Thursday to go in greater detail with our performance incentive mechanism, but I will be available for questions on that today as well. So in regards to the topics that were put forth by PSE staff, Mr. Baker, as far as the appropriate rate of return, under the current structure of EmPOWER, we think that it's appropriate to continue with the authorized rate of return, given that there's a 5-year collection period and the utilities are financing those energy efficiency spending over that time. However, if there are changes that are made in the near future in the upcoming cycle, including reducing or expensing some of the costs or expenditures, then maybe that could be revisited. But at this time, the appropriate rate of return is the weighted average cost of capital. As I just stated, it gives the utility the opportunity to earn the rate of return on the funds that they are providing and is being held or being set aside for that period of time. In terms of amortizing behavior and administrative costs, our comments pretty much stated that it requires a deeper look at all the programs that are being proposed and the commission decision on how those programs should go forward. So in the greater context of the rate impact overall, the programs that are proposed in the 3-year, the 21 to 23 cycle, if the behavioral and administrative costs being expensed on an annual basis does not have a significant impact on those rates, then it may be appropriate to do so, but it would require greater detail and investigation on how that will impact the cost. Finally, the third topic I'd like to address right now is the performance incentive mechanism. The cost recovery work group included two proposals by MEA. I would like to state at this time that we continued the investigation, and due to the impacts of COVID-19 and the potential the continued economic condition, it might not be appropriate to institute or to implement a performance incentive mechanism in the upcoming cycle. Now, we were looking at, and one of the reasons we looked at some of the assumptions that we made, including the potential that the customer growth would be there, is probably not going to hold. We don't have enough information to clearly state that yet, but it's something that is a concern to us, and at this time we don't recommend going forward with the performance incentive mechanism. However, we appreciate the opportunity to present the analysis on Thursday to the commission and provide these two options as something that could be looked at going forward, and that could be considered when we have more information about the impacts on customers and rates. And at this point, I will take any questions. I know Commissioner Herman mentioned the report and had some questions. I can address those now, or we can follow up on Thursday with our consultant in that presentation.
Commissioner Herman, would you like to return to page 17 or wait till Thursday?
I guess what I hear you saying is that you're not sure whether or not going to a 1-year recovery for the behavioral and the utility administrative costs, you don't have a position on it because you don't know the impact of it. Is that what I heard?
That is correct. At this time, looking at the the proposals that were made by the utilities, and we'll discuss that in detail later this week. It comes down to how those costs will increase and how adding, instead of expensing these costs over 5 years, will impact the rates. Now, staff had some analysis from 2 of the utilities, and it shows that there is some impact, but it also is a function of what programs get approved and how they're implemented going forward as well. So at this time, we don't have a clear position on that, other than to say that it's appropriate to look at the overall impact from all the different factors.
Okay. But that would, well, it wouldn't necessarily reduce the, well, I guess overall it might reduce the unamortized balance over time because you're doing it for at least that part.
So I guess 80% or approximately 80% of those costs would not get assigned to the unamortized balance if we expense on an annual basis. So that would reduce the unamortized balance going forward each year.
Right, right.
Relative to, doing it over 5 years.
Right. And while you sort your report seems to kind of like the PIMS, but you're concerned right now that it's just not the right time. Is that right?
That is correct, Commissioner Herman. When we did the analysis, we started the analysis, we thought we would be able to look at the rate. Well, we looked at the rate impacts over the next 10 years. So the analysis that we did looked at 10 years, potentially to pay off the $800 million, over $800 million in uncollected program costs. And so it would require a steady increase or some increase in costs over the next, the upcoming years. And timing that with potentially a recovery from COVID may not be the appropriate time to do so. So and again, we present the analysis. It kind of shows what would be required to pay off the balance if we go with an approach like this. It could potentially increase rates by over 20% for a few years. And then it will, the end goal would be to lower the overall surcharge to customers, which would be achieved when we get to the expensing mode. But to get there, it would require some increase in the rates, which may not be appropriate over the next few years.
Okay. And so you're saying take it off the table through 23, right?
Yes. And some of the other stakeholders mentioned that, it may be appropriate to look at EmPOWER in a broader sense, given that the current mandate will expire in 2023. So if there are opportunities to incorporate it in a new structure, that would be worth looking into or exploring as well.
Okay. I'm looking at page 33 of the Oculus report.
Okay.
On alternatives ranking.
I'm 1 second, please. I will go to that page. You said page 33?
Mm-hmm.
Okay. You can go ahead. Thank you.
Okay. So I'm a little confused because it doesn't tell me, is one good or is 10 good? I didn't get I was like, you didn't tell me which one,
Right. So, and our consultant will go into it in greater detail on Thursday, but a lower number is better.
Okay.
In the general sense, yes.
All right. Thank you. That I just I kept looking around like which one am I supposed to be looking at there? I think that's all I have for now, and I appreciate it. Again, I really want to thank you for this report because it was really helpful for me. And so thank you very much for doing it. It was really a worthwhile endeavor.
Thank you.
Richard?
Thank you, Mr. Chairman. Again, thank you, Dr. McNeil, for your presentation this morning. And I want to join Commissioner Herman and thank you for this report. I think it provided us with a lot of great information. Just in your overall recommendation, I just have a couple high-level questions for today. But you're recommending that we I guess skip this cycle as far as making any significant changes. Is that correct?
Well, I guess I will restate that at this point, at the beginning of the cycle, it may not be appropriate. I mean, conditions could change in a year or two. So I guess I will restate that position that at least at the beginning of the cycle, it may not be appropriate. But as we get more information, things may change within a year or two, and it may be appropriate to look at it that way. And I also would like to reiterate that given that the current mandate ends in 2023, is there a possibility, if there are possibilities to incorporate performance incentive mechanism into a different structure, this provides some information that could be used to do so. But again, we would recommend that we at least wait till we have a little bit more information about the impacts of COVID and how the programs will be implemented going forward before decision is made on performance incentive mechanism.
Okay, fair enough. Have you participated in both the cost recovery and the PC 51, the PIM work group? Just want to get some insights as to what's happening there.
I'm sorry, because I missed the last part of the question.
Oh, I just wanted to get some insights. So you have participated in both of those work groups?
That is correct.
Okay. Has this discussion about looking at the EmPOWER program and pairing them with some PIMs, has that been discussed in both of these work groups?
So the decision in the PC 51 was made to push the performance incentive mechanism for EmPOWER to the work group, the cost recovery work group. So as far as incorporating EmPOWER energy efficiency into the PC 51 hearings, that was not pursued. And so it was taken to the cost recovery work group instead.
Okay, so you think that that's an appropriate place for this to be discussed in the cost recovery? And I just asked that because I think there was another recommendation that it might be considered in the OPC. I'm sorry, I think OPC made the recommendation it be discussed in the PC 51 context. So,
if I will let OPC address this, but I thought they were saying that we should embark on a similar venture, which is to look at performance incentive mechanisms for EmPOWER in a work group similar to PC 51. So if that is, and again, I will let OPC correct that, but that is what I thought was being said. And yeah, MEA supports looking at this further in a work group setting. And again, that will provide us with the opportunity to incorporate any additional information that may come in. And if there are opportunities to look at this in a broader sense, if the commission deems it appropriate to look at EmPOWER or energy efficiency on a broader sense beyond the upcoming cycle, then that would be appropriate.
Okay. And then just last question. This is an opinion question for you. Just looking at your various options and given your experience with these work groups, if the commission were to consider something like adopting a option 4A, 4B, or 4C, right away, do you think that might be an incentive for these work groups to try to get to then 5A, 5B, or 5C with a PIMS model? Do you think that might be something we would want to consider?
I'm not sure if it will create that impetus to move from the 4A to 4B or 4C to a 5A, 5B scenario. However, it would provide at least the impetus to have a more detailed and lively discussion about performance incentive mechanisms. So if I understand you correctly, 4A, 4B, and 4C would be an immediate reduction in the weighted average cost or the rate of return on energy efficiency spending. And would that allow us to move to another or an incentive mechanism where there's a potential for incentives to be paid? So I will restate my point there. I'm not sure. It might lead to a lot of contention that would probably not get us to where you were hoping to in the near future. Immediate reduction, an immediate reduction in the rate of return may actually slow the process. But it's something worth considering if the commission thinks is appropriate. As I stated earlier, MEA's position is that because of the current structure of EmPOWER with the 5-year collection and the utilities financing upfront, it is appropriate to use the weighted average cost of capital. However, the discussion as to whether immediate reduction, and then moving to an performance incentive mechanism is something that could be explored and eventually would get us to a point, but I'm not sure it would be an expeditious process.
Okay. Well, great. Well, thank you for your presentation this morning and for your answers. Thank you, Mr. Chairman.
You're welcome.
Thank you. At this time, we'll turn to the utility representative. I believe there's just one, but there may be more than one.
Yes. Good morning, Chairman and Commissioners. I'm Lori Duhan, and I'm the Key Manager of Energy Efficiency Portfolio at Baltimore Gas and Electric Company. My comments are representative of the EmPOWER Maryland utilities, and BGE, along with the other utilities, are available to answer any questions or provide additional insight. The utilities continue to find that the current treatment of EmPOWER Maryland investments as a regulatory asset with a 5-year amortization period and the unamortized balance earning the utilities' weighted average cost of capital is appropriate and is part of the reason why Maryland's programs are so successful. Monday morning and even today, parties are noting the cost effectiveness and success of our programs. EmPOWER Maryland expenditures are truly an investment. They're an investment that provides long-term benefits to Maryland. They help Maryland meet energy needs just like any other energy investment. They incentivize customers to invest in long-term energy equipment. EmPOWER Maryland is making capital investments in our customers' homes and businesses. And they reduce each utility's need to invest in capital necessary to ensure safe and reliable distribution of energy. We're investing in megawatts, not megawatts. These programs are just as important to serving customers as all other distribution investments. By reducing other capital expenditures and energy consumption, the investment that the utilities make in EmPOWER Maryland provides significant long-term financial and environmental benefits to the residents and businesses in the state of Maryland. For BGE, since the inception of EmPOWER through 2019, our average residential electric bill is down, even with the EmPOWER surcharge, nearly 25%. For electric, that's $425, and the gas bill is down, this is residential, 15%, or $160. That's real money. As with other distribution investments, EmPOWER investments ensure safe and reliable distribution of energy, are funded upfront by investors, and are later recovered from customers over the period that they receive the benefits. EmPOWER investments are a regulatory asset, and cost recovery has appropriately been treated in exactly the same manner as physical distribution plant investments they are replacing. Consistent with other utility investments, the appropriate rate of return is the individual utility's most recently approved weighted average cost of capital rather than an arbitrarily selected rate. The average life for EmPOWER Maryland measures is greater than the 5-year amortization period. Clearly, they're providing energy savings benefits to our customers well beyond the current 5-year amortization period. Intergenerational equity is a cornerstone of sound utility rate making. In addition, to ask customers to pay for investments over a shorter period of time, for example, in the same year they are spent, would be asking them to pay for savings and benefits before they ever receive them. The utilities agree that the behavior program has a 1-year measure life and recognize that expensing behavior programs will mitigate the growth in the unamortized balance, helping to manage the return component within the surcharge in the future. Utility administrative costs support all of the EmPOWER programs. That is why they've been provided the same cost recovery treatment as the program costs. However, in an effort to further mitigate the growth in the unamortized balance and manage future surcharge increases, the EmPOWER utilities offer to also expense utility administrative costs. We are willing to expense behavior and utility admin costs in the years that they are incurred while continuing to amortize the remaining programs over 5 years. While the utilities believe the current methodology for over-under recovery is appropriate, we offered a proposal that any over-recovery component can be incorporated into the annual calculation of the EmPOWER Maryland surcharge going forward, rather than making it a COVID-19 one-time opportunity. The goal would be to first mitigate increases in the surcharge and then manage the unamortized balance. If there is an over-recovery, the utilities propose to first offset any increase in the surcharge from the prior year. If that is accomplished, The remaining over recovery would be applied to the unamortized balance. So that would be another effort and opportunity to limit the growth in the unamortized balance. And before Commissioner Herman asks, BGE's commercial and gas energy efficiency programs are both underspent and revenues are undercollected across everything but the electric residential EE. It's pretty close to a wash, and I can't tell you what that would necessarily translate to the rate, but it's pretty close to a wash. The residential energy efficiency programs are both overcollected and underspent, about $2.5 million underspent. But where we do have a noticeable variance clearly related to COVID is with our Smart Energy Rewards program. We made the conscious decision due to COVID not to call energy savings days, and our 2020 budget was approximately $15 million. I, along with the other EmPOWER utilities, are available for question.
Thank you, Ms. Doohan. Earlier, you heard me reference staff's request for the projected forecasts. Does BGE, DPL, PEPCO, or SMECO have any concern with providing this information within about 2 weeks?
I will say no, that we will be able to provide it when we provide our filings. Our original plan was to provide you the filing status quo, and then when an order came out, so that we didn't have 4 or 5 scenarios out there. When an order came out, we would have then revised it to be consistent with your order. However, if the commission prefers to have information, we can certainly provide it.
Staff does require that information to provide their analysis. I'll allow the utilities to discuss this on break, but it would be the commission's preference if this information could be filed by Friday, November 13th. And Ms. Doohan, if you could respond to me after lunch to see if all 4 utilities could provide that information to staff.
I will.
Thank you. Commissioner O'Donnell.
Mr. Chairman, thank you for recognizing me. I've changed my mind. I'm not going to ask any questions of the utilities.
Thank you. Let me, before asking additional commissioners questions, I wanted to see if there were any other interested parties in the room that wanted to speak to the commission.
Commissioner and Chair, this is Brian Talley. I work for Delmarva Power and Potomac Electric, and within that role, I'm a manager within the regulatory department. And I did just want to add to some of Ms. Doohan's comments and specifically respond to some of the things that have already been said today by the various parties, including OPC and the presentation they performed, as well as MEA. And as you cited, there was original filing by the working group on 8/14 of this year, and then the utilities had a follow-up meeting or follow-up report on 8/18. And I just want to kind of expand upon those a little bit, some of which was brought up by OPC. And within that filing, I believe it was on page 10 of the 8/14 report, it showed an increase, much like they presented today, to if a pay down occurred over a 10-year period for approximately 12%. And our response to utilities had 2 concerns with that. One is that original calculation was performed by OPC within the working group context in June of this year. And then utilities gave feedback around it. And ultimately, there was another calculation performed by OPC that actually grew it from 12 to 20%. And that's what we cited in our report on 8/18. So that was one of the concerns, that there was a later calculation that was not incorporated into the working group report. The second point, aside from the percents, we were concerned about the dollar impact. And effectively, it showed 77 cents. You heard it today from OPC. And as they cited, but I just want to reiterate, that's just one aspect of the surcharge. It was BGE they were doing an analysis around, but I'm familiar with that surcharge. And effectively, that surcharge of the 77% that would be impacted to the residential customer, that was just Rider 2, which was the EE programs. There's 3 components to that surcharge. There's also Rider 15, which is demand response, and Rider 26.
Mr. Talley?
Yes.
First, Ms. Doohan, can you mute your microphone? Thank you. We did receive your 3-page letter regarding your dispute with OPC, so we don't need to get into the numbers or the details here. We have that available.
Okay.
Anything else you'd like to add?
No, just that effectively that 77%, if you included all those components, would be greater. The other thing, really quickly, Chairman, if you allow me, is that just responding on MEA, that they did agree to the weighted average cost of capital as it was cited. But our concern is that a lot of the analysis that was performed by MEA and we cited within the group was that it kind of combined the residential and the commercial customers at the same time. And so it was very difficult to understand the aspect associated with the residential individually or the commercial customers. And one other quick point is that within their discussion around amortization, they showed an expense mode at one point, I believe is page 17, as you may have seen. The concern there is within that, the PIM concept is that the weighted average cost of capital could be increased or decreased within that process. But the problem is if you're in expense mode, you're effectively going to be targeting zero unamortized balance. So that becomes less and less relevant as we get further away from 5-year amortization, if that's what occurs. With that, I appreciate your time.
Thank you, Mr. Talley. Since you're here, I'll ask you, can you get the commission that information I requested by Friday the 13th?
I believe we'll talk at lunch, but I do have one quick question, whether you or Mr. Baker. We did include Appendix A in that filing on 8/14. Is that what above and beyond, and maybe I missed it in a dialogue, what else are they looking beyond that, the impact?
I believe they were looking for the projected surcharges, but Mr. Baker, would you like to elaborate on the request?
Yes, we're just looking for what Potomac Edison Washington Gas filed, which was on the program plans, what the projected surcharge is under the expensing of behavioral and expensing of behavioral plus administrative. So that's basically so you can do the full surcharge impact analysis if the commission wants to consider that for their decision before if they want to use that in their decision making. If the commission doesn't want that in their decision making, then it becomes less necessary. But that information would be helpful for that.
Okay, thank you for that insight. We'll talk over lunch as you suggested, but I believe PHI, the Delmarva, and Pepco should be able to achieve that.
Thank you. And the request would also apply to Southern Maryland Electric Cooperative. I have no questions for the parties at this point, but before I turn to my colleagues, let me say that this is a bit of a complicated issue. I recognize that using the weighted average cost of capital and awarding the utility their ROR is it's easy money for the utilities. I recognize that they're financing a lot of these EmPOWER investments up front, so I do sympathize with OPC's arguments. At the same time, any effort or undertaking is going to have some type of cost of capital associated with it. And these EmPOWER programs, I believe it's about 15% of the budget is comprised of carrying costs. And like anybody with a mortgage, you recognize a significant amount of your payment goes to interest every month. Now, we do have a large unamortized balance approaching $1 billion. I think it's 800 million. And the question is now, do you pay your mortgage up front tomorrow and experience that rate shock? Or do you finance it over a longer period and recognize that part of your EmPOWER surcharge is going to be just to have the program administrators handle the money? This is a difficult issue. I recognize that we have a number of proposals, including a no action alternative before the commission here. But I do appreciate all the thoughtful analysis that our staff, MEA, and OPC have provided. I'll turn to my colleagues for questions, if any. Commissioner O'Donnell.
Mr. Chairman, based on those comments, I would like to make a couple comments myself. I have, along with other commissioners, have been concerned about this issue for a long time and have voiced continuously, and the commission has voiced continuously, a desire to look at the financing of behavioral programs. And we've sent it to the work group, and the work group came back and nothing. Sent it to the work group came back, nothing. Finally, this is the first time that there is, after almost demanding that something be done about this is the first time that we have concrete proposals in front of us to address these issues, and they are complex. and they're difficult. But Mr. Chairman, with all due respect, I don't view it as, you know, biting your mortgage all at once as the rate shock. Conversely, I think the status quo is making a minimum payment on a high interest credit card. And that high interest credit card never gets paid off. It never gets paid down. And we're carrying almost $1 billion of unamortized expenses, and the ratepayers are paying the minimum payment on the rate card, on the credit card. And I just think that that's untenable going forward. I think we have to address this somehow. I'm not going to prejudge it here, but I'm glad to see that there's finally some action being proposed in a concrete manner. So I want to thank all the parties for their various perspectives, but I had to get that off my chest. Thank you.
Commissioner Herman?
Thank you. So I have some questions. Ms. Doohan or Mr. Talley, is MEA's analysis correct that the total unamortized balances are about $822 million?
I'm not
This
sure
is,
I have that. Go ahead, Lori.
I was going to say, I was going to ask you, Brian, if you knew. I truly do not know.
I don't know all the utilities to know to answer your question. We can find that information.
Okay, so you're not necessarily disagreeing with that number, but you haven't looked at that number?
In total utilities, no. I don't think we have that exact number now.
Okay. How do you respond to the OPC's argument that our state is one of the few states that amortize these costs?
Laura, if you want. There is a few states, one actually New Jersey just passed it. Will, you can chime in as well. I see Will Ellis. But effectively, there's other mechanisms as well when you don't have that amortization. But Will, do you want to expand upon that?
Yes, thank you for the question, Commissioner Herman, and thank you, commissioners, for allowing me to speak. William Ellis on behalf of PEPCO and Delmarva Power. Yes, I think that is an analysis that is accurate that OPC stated that there are not a lot of states that allow amortization as a part of energy efficiency spend. In contrast to that, I would say that there are not in a lot of states where utilities are the program administrators for that particular program. But I will say that if you look at the trend across states where utilities are the program administrators, they are turning to a amortization model in order to pay for the cost of the energy efficiency programs. You have seen that recently in states such as Illinois, New York, as well as just recently in New Jersey, where they have proposed a similar cost recovery mechanism, such as the one that we have in Maryland.
Okay, thank you. Do you know, any of you, like the behavior and administrative costs, what % of the total cost does that represent, if anybody knows?
I don't have the math for the %, but I can tell you that utility admin for 2020 was about $4.5 million, and behavior was about $6 million, but you have to back out some utility admin in the behavior. So it's between $8 to $10 million out of maybe $170-ish million program for Baltimore Gas and Electric. And that's looking at the 2020 numbers.
Okay, thanks. That's helpful. So it's not a large percentage of the annual spend on EmPOWER then.
So it looks like it's a little less, maybe 7-8% without me having a calculator in front of me. So it's a noticeable amount to help drive down the unamortized balance going forward without having a huge impact on rates.
Okay. Oh, and Mr. Talley, I got some numbers from Ms. Doohan. Do you have comparable numbers for PEPCO and Delmarva?
Yes, we are very similar. Basically, at this point, from a residential standpoint, for DPL or Delmarva Power, we're about, to date, about 600,000 over collected and a $1.2 million for PEPCO. A lot of that, as Ms. Duhan cited, was around the fact that there was less critical peak days called in 2020 so far. On the commercial side, we're seeing the opposite effect in terms of there's less sales, and therefore it's a function of spend, but also a function of the revenue stream, and that revenue stream is down for the commercial side.
Okay. And I thought, Ms. Duhan, didn't you say you didn't run any days? Is that right?
Had no energy savings days this summer at
Right.
all.
Okay. And Mr. Talley, did you run any?
I believe there's one requirement every year. I'm not an expert at that, but I thought we just did run one as a requirement each year, but it was fairly small.
Like a test?
Yeah.
Yeah. Okay. All right. Thank you very much. That's all I had right now, Mr. Chairman. Thank you.
Well, again, thank you to all the work group participants. This is a thorny and complicated topic. I do sense, as Commissioner O'Donnell noted, there are some proposals on the table, which we haven't had in the past, so we are going to be moving forward. At this time, let us take a 15-minute break. We'll reconvene at 11:35 and start with the presentation by Potomac Edison. So we are in recess until 11:35 a.m. Thank you. The commission will resume in approximately 1 minute. We are back on the record in case number 9648. Over the next hour and a half, we will be reviewing the program proposal by the Potomac Edison Company. It's not an inexpensive proposal. I believe it's they'll be hitting record highs in terms of the proposed budget over the next year. I'll turn it over to the company to begin its presentation. Good morning.
Good morning, Mr. Chairman and Commissioners. Potomac Edison appreciates the opportunity to review our proposed portfolio plan with you.
Oh, sir.
Yes.
Sorry. Can you please state and spell your name for the court reporter?
Yes. My name is Kurt Turosky, K-U-R-T, last name Turosky, T-U-R-O-S-K-Y. And Mr. Rundy is going to be sharing the PowerPoint presentation as we go. He'll be presenting. Again, my name is Kurt Turosky. I am First Energy's Director of Energy Efficiency, Compliance, and Reporting. I am joined today by Jeff Trout, our Corporate Counsel, and Edward Miller and Eric Rundy, who are the Chief Architects of our 2021 to 2023 portfolio plan. I'm going to start and kick off the first probably 7 slides today of the presentation and give you a high-level overview of our EmPOWER plan in terms of the targeted savings levels, the proposed budgets, projected rate impacts, and then some flexibility requests that we have. And then I'm going to turn it over to Mr. Miller to provide the specific details on the individual residential and non-residential program components, including what new changes and offer have embedded in the plan compared to our 2018 to 2020 plan. Moving on to slide number 2. As our team was building the 2021 to 2023 plan projections, we realized this plan cycle savings targets will be very difficult to attain. As you can see in the table, while Potomac Edison has successfully exceeded each of our prior plan cycle targets, and in the aggregate, we've achieved 120% of the 2009 through 2020 EmPOWER targets. Our next 3 years targets on average are 66% higher than the average savings level attained during those prior 12 years. And these targets also represent a 24% increase in savings over our 2018 to 2020 targets. And with that 20% increase is going to be even more challenging, given that the market potential for residential lighting savings will be significantly diminished in this upcoming plan cycle. And that factor alone, coupled with other factors, including the increased targets and the diminished residential lighting savings, are going to are the main reason for that increased spending the chairman was kind of mentioning earlier. Our 2021 to 2023 plan design reflects several refinements to the existing plan, coupled with a few new offerings. And again, Mr. Miller is going to cover those programmatic changes in a few minutes. We also currently have efforts underway to try to work with and finalize vendor contracts once we have commission approval of our plan, to be able to smoothly and seamlessly implement the new plan beginning January 1 of 2020. As we turn to slide number 3, we have included a very comprehensive suite of program offerings in our plan, and they're all geared toward ensuring we can meet all of the regulatory requirements, including exceeding 146,000 and 148,000 megawatt hour targets in a cost-effective manner, while ensuring there are equitable offerings across all customer classes. In order to achieve these aggressive increasing targets, we will need to strive for continuous improvement of our existing programs and aggressively pursue new measure opportunities as they present themselves. We are also enhancing incentive opportunities to try to drive the increased customer participation that we're going to need to hit those increased targets. We will also work collaboratively with DHCD to try to maximize participation by our limited income customers in this new plan cycle. And the new plan incorporates several new program ideas and technologies. The plan also leverages the successes and lessons learned by our Maryland EmPOWER peers under the EmPOWER program, as well as lessons learned by our First Energy affiliates in other jurisdictions. And our proposed plan is cost effective as it produces an overall total resource cost test result of 1.4. And then both the residential and the commercial sectors also have a 1.4 total resource cost test result. On slide 4, we provide a sector level and annual breakdown of our projected 2021 to 2023 portfolio savings. Now, I will indicate these savings levels exclude the limited income DHCD savings. So these are only in direct administered programs. From a sector perspective, you'll note that the projected residential savings decline across each of the 3 years as the market potential for residential lighting is decreasing over time. And in the commercial industrial sector, we project savings to increase year over year due to more aggressive customer outreach and marketing, as well as an increased emphasis and increased incentives on programs like building retro commissioning and our custom sub program, as well as the small business direct install program. So we're really going to look to try to drive those programs harder to get toward our targets, recognizing the savings from the residential sector are likely going to be declining. The other program cost category does incorporate a modest level of energy savings to be realized from our transmission and distribution system. On the rows at the very bottom of the table, you will see forecasted savings for each year exceed the annual targets as outlined in the commission order 88402, ranging from 103.2% to 107.8%. As we move to slide 5, this provides a sector level and annual breakdown of the 2021 to 2023 portfolio costs. And if you look to the far right column, you will see that the budget is split 54% residential and 46% for commercial industrial customers. I'm sorry, I've got that wrong. It's split between residential 44% and the commercial industrial 56%. Sorry about that. And the forecasted cost for the overall plan, $147.7 million, or approximately $49 million per year. And it's about a 25% increase from our 2020 program budget. And similar to the savings shift that we saw from the residential to the commercial industrial sector, you also see a shift in the overall budget between the sectors, reflecting a shift again in the market potential over the planned period. It moves from a 50-50 split approximately in 2021 to closer to a 40% residential, 60% commercial industrial split in 2023. As we move over to slide 6, we've incorporated an overview of what the average monthly EmPOWER surcharge cost is projected to be across our various rate schedules over the planned period. I will mention these rate impacts do include the DHCD income budgets. And based on the cost recovery work group that we just had the discussion about, we've prepared this table for each of the 3 cost recovery scenarios that are outlined in that report. So the first three columns, or first set of columns there, reflect the continued amortization of all cost over 5 years. The middle set of columns reflect the rate impact if behavioral costs are expensed in the current year, with all other costs continuing to be amortized over 5 years. And then the final set of columns reflect the rate impact if we expense behavioral and utility administration costs in the current year, and then amortize all the other costs over the 5-year period. If you take a look at like the residential customer, the average Potomac Edison residential customer uses about 1,147 kilowatt hours per month. Their monthly charge is projected to increase to about $96 in 2023 under the current 5-year amortization approach. You see the $8.03 charge there, or up to $100 per year in 2023 under the far right column, where you're amortizing behavioral and utility admin costs in the current year. So you see about a $4 shift if you do that by 2023. And then as you look at the commercial industrial rate schedule, you do see more of an increase from 2021 through 2023, as we mentioned earlier, as the amount of savings and the overall spend in that sector is increasing. And then before leaving this slide, I know there was a question of one of our peer utilities earlier in terms of over or under collection. I did just want to indicate that Potomac is currently under collected by about $150,000, of which collection in residential sector and about an $80,000 under collection in the commercial industrial sector. Moving to slide number 7, I'd like to briefly touch on some existing commission-approved budget and incentive flexibility that we would like to see continue into the next plan cycle, as well as highlight 2 additional flexibility requests that we would like the Commission approve for the next cycle. Over the last few years, the Commission has granted utilities the ability to adjust budgets and change incentives within approved ranges to allow utilities to react quickly to varying market conditions. This flexibility is beneficial to the utilities to maximize savings opportunities, as it allows the utilities to sustain momentum in certain programs that may be overperforming, and also to adjust incentives upward if needed to drive increased performance in other programs, or potentially push incentives downward to avoid potentially overpaying for the program performance. So the flexibility that we currently have that we would like to see continue into the next phase includes the ability to reallocate up to 15% of the approved residential sector budgets between programs within the sector with 10 days advance notice to staff, and reflecting such shifts in the subsequent semi-annual reports. Second, the ability to reallocate previously approved incentive funds between programs between the C&I sector, subject to the same staff notice and reporting in the next semi-annual report period. Third, the ability to decrease residential or C&I incentives by any amount within the approved range. And finally, the ability to increase C&I incentives by any amount within the up to range without commission or staff approval. And to improve the flexibility, additional.
Sir, you are on mute for some reason.
I'm sorry, where did I somehow, I lost the connection for a minute.
You were about to start the second blue square, the new requests.
Got it. Thank you very much. Sorry about that. I got a pop-up that I had a Cisco disconnect there for a minute. Okay, and to improve the utility's performance going forward, we would like to ask for 2 additional enhancements to the flexibility request. The first is the ability to reallocate up to 15% of the total C&I sector level budgets between C&I programs, which is the same approval we currently have for the residential sector. And then the second item is the ability to increase residential incentives by any amount within the approved range, the same approval we have currently for the commercial and industrial programs, and again, without the need for staff or commission approval, because the commission has already given approval for the range area. That's what I wanted to cover here, and now I'm going to turn the presentation over to Mr. Miller, who will review the key programmatic changes within the portfolio plan itself.
Thank you. And before we move to Mr. Miller, may be a good time for commissioners, if they have any pressing questions of you, to ask them, or we could ask you at the end of the presentation.
Okay.
Mr. Tarosky?
Yes.
All right. Thank you, Mr. Chairman. I just had a couple of questions regarding some of your projections on, I think it was slide 4. Might have been 5. The number was kind of small on there. I didn't see it. I'm curious as to how the company incorporated some of the impacts from customer usage patterns that have changed as a result of COVID-19. Got a lot of customers working from home now, living at home, obviously living at home, but staying at home more frequently than normal. So how did you incorporate those into your projections in order to, well, I'll start with that. How did you incorporate into your projection?
Well, I will start, and I'll ask Mr. Miller or Mr. Rundy to embellish upon it. But as we look forward to 2021 to 2023, certainly in 2020, we've obviously seen an increase in residential usage and probably a decrease in some of the commercial industrial usage. However, hopefully most of that commercial industrial usage has come back a bit. But going forward, it's hard to tell in terms of that switch to the increased residential usage, how much that will or will not continue. Again, we still do have a fair amount of savings projected in our plan for the residential sector. And in 2021 and 2022, it really starts to fall off at a bigger clip in 2023. I hope by that time, and certainly much sooner, we'll be back to our normal live schedule, but who knows how things, might change in terms of trends. But Ed or Eric, do you want to embellish on that?
Sure. Thank you, Commissioner Linton, for the question. That's a very good question. To follow what Kurt communicated is, in developing our plan and our plan projections, certainly the concern associated with COVID, the current pandemic, has been with us the entire plan development cycle. Throughout the plan development process, we work closely with our implementation team and also with our current vendors in just developing our participation projections going forward based on how programs are currently performing and based on I'll say the observed reactions to the programs at the time that we were developing our projections. Certainly I think it's going to be a very long time until everyone fully appreciates the impacts of the current pandemic. I agree with Mr. Tarosky regarding hopefully we get this behind us sooner than later. And I think it really underscores both our request for the flexibility to continue in the enhancements. I believe that over the past few months, we have seen the utilities being very flexible with their programs and looking at new and innovative ways of delivering the program, such as yesterday when Aaron Demaray presented on doing the school education program virtually later this fall. So I think the key to going forward is going to be the flexibility, both with our implementation, but with all the parties, so that the utilities are in the best position to really strive to meet their program targets as best as we can.
Thank you for that, Mr. Miller and Mr. Tarosky. And talking about the allocation flexibility was my next question. You're using similar numbers in terms of the flexibility range, at least your current request. relies on the same numbers as what you had during the last program cycle. And I was just curious if you saw the need, if that was acceptable or would it be satisfactory in light of the possibility of there being some change in customer usage patterns as a result of the pandemic. In other words, do you need a broader range, or is that range still acceptable?
That's also a very good question. I will say a lot of our development of our proposal for the two additional adjustments was leverage what has already been accepted and approved by the commission. Certainly having a larger range regarding budget shifts would be beneficial, recognizing the uncertainty. I will say that we did successfully, work with staff. I remember correctly, either earlier this year or last year, where we did shift some budgets from an underperforming program to support the new construction program because it was performing well at that time and was in need of additional budget monies. So I would say that the 15% between program budgets, certainly an increase in that would be beneficial. And I think in other states, if I remember correctly, I've seen it at 20 or 25%.
Okay. Thank you very much for the answers. Thank you, Mr. Chairman. That's all I have.
Mr. Chairman.
Thank you. Commissioner O'Donnell.
Thank you, Mr. Chairman. Mr. Miller or I guess Mr. Miller. You told Commissioner Linton that your concern or consideration of COVID-19 impacts was with you during the development of the entire 3-year plan. Did that temper your 3-year plan development with regard to the overall budget? Because a 25% increase is a significant increase. $100 a year surcharge for energy efficiency programming is pretty significant. So did you consider that? Because people are hurting.
Yeah.
I can't.
Hey, Ed, this is Kurt. I'm back now. Sorry about that. I did lose connection. I'm back. I'll start. Ed, you can embellish. I think we do recognize this is the budgetary increase is a sizable increase. But as I indicated earlier, our EmPOWER targets that we're facing, are, I think I mentioned, a 24% increase over the prior 3-year plan period. So when you look at the budgetary increase in relation to the target increase that we're faced with, it is fairly relational. So, while we understand that, it is a sizable impact, I would also add that, our programs do show to be cost effective, again, producing a 1.4 total resource cost test result. So hopefully, in the long run, they're going to be beneficial to customers, even though we do see a steep increase from our current 3-year plan cycle to the forthcoming 3-year plan cycle.
So my question was, did you consider the impacts of COVID when developing the budget? I'm not sure I heard an answer to that question.
I'll go ahead and follow up and hopefully answer your question, Commissioner O'Donnell. I will say the impacts of COVID did impact the budgets, however, more so indirectly. And what I mean by that is in developing our plan and our programs, we looked across the program portfolio and focused on the participation projections for each and every program. In developing the portfolio of programs and ultimately to meet the targets that we have. And the budgets are developed based on the performance that we are projecting for each of the programs. So the participation projections, which are based on at least our projections for each and every program, recognizing the current pandemic situation, is one of the many factors that influenced our participation projections, which influenced our budgets.
did you think about how $100 surcharge for EmPOWER might impact your arrearage rate or default rate with regard to arrearages, if at all? Is that a consideration? Because I'm sure like every other utility, you got a pretty high arrearage rate right now.
Yeah, I do recognize the surcharge impact. I know that's something that has been communicated and discussed with the commission over the prior plan cycles, and that is definitely a concern to us as well. However, in order for us to meet our targets, we developed what we believe to be the best portfolio of programs, recognizing the opportunity, taking into account our experience and input from implementation and the vendors in order to develop a plan to strive to meet our targets.
And I would add that, we're using this $100 charge. It's not just so it's clear, it's not an incremental $100 charge. We're saying that would be the charge over the year for the residential customers. Today's rate, I don't have it off the top of my head, but in total, it's, probably $80 or $85 or something. So we're talking about an incremental increase of, a few, couple dollars a month, or $1 to $2.
Probably $2. You're probably closer to $6 right now, and probably going up to 8 and change. So okay. Will you be presenting more details of the program components? I suspect. Like, I'm going to be interested in how much you're increasing your behavioral program, et cetera, et cetera. You're going to present all that, right?
Yes.
Okay. All right. Thank you, Mr. Chairman.
Thank you. Mr. Miller, are you in a position to proceed with your presentation?
Yes, I am.
Okay, please proceed.
Okay, thank you. Good morning, Mr. Chairman and fellow commissioners. As we just discussed, in some of the questions, and as Kurt presented a little bit earlier, we developed a comprehensive portfolio of programs that, we're leveraging our experience, our industry input and research, and it also incorporates our things to help us to meet our increasing and aggressive EmPOWER goals for 2021 to 2023. What I'm about to present really reflects an evolution of our existing plan with expanded offerings. And I want to highlight the expanded offerings because we believe that it's essential that we provide our customers with more opportunities in order for us to, achieve the participation that we need in order to meet our aggressive targets, and also to give customers more opportunity to participate and benefit from our programs. Turning to slide 9, this slide provides a summary of our residential energy efficient products program. As shown on the slide, the program includes 4 sub-programs: appliance rebates, appliance recycling, consumer electronics, and residential lighting. At a high level, these programs and sub-programs are a continuation of our existing plan and sub-programs. And the column on the far right of the slide illustrates the key changes that we're making to the program for 21 to 23 to improve our offerings. I want to highlight a few of the more notable changes to this program and sub-programs. The first one that I'm excited about is we are proposing to work with retailers to target the purchase of select Energy Star appliances instead of non-Energy Star units in stores. This change is actually based on a stakeholder proposal that we received late last year, and this is also has been referred to as the SHIFT model. So this is a program that's exciting because it's very targeted and specific to the retailers, and it's working with the retailers to basically identify what are you currently selling that's not Energy Star related, and providing the incentive in order to move customers who are going to the store with more of the intention to buy a lower cost appliance, working with the stores to apply the incentives in order to achieve that customer participation in an Energy Star rated appliance. So this is one that is exciting to me because it's really targeting customers that might be more budget minded, who are going to the stores and shopping on price as opposed to efficiency. So this is one, again, it's exciting to me and one that I really like. For the appliance recycling program, another improvement that we're making is we're expanding the program to target and provide bulk collection events for smaller appliances, including room air conditioners and dehumidifiers. This is another, what I believe is an opportunity and an improvement for customers who, as opposed to going out and buying something new, this is an opportunity to remove inefficient appliances from our customers' homes. And it's really a program that I think has a lot of opportunity because by doing a bulk collection event, this leverages economies of scale, both from the program delivery standpoint, but also captures a lot of opportunities, through the community events. I will highlight that this is based on successful events that we have seen at other utilities, both in Maryland and other states, and we've heard feedback from other utilities regarding how successful these are with just achieving a lot of participation in the program. Some of the other changes that I just want to highlight quickly is we are revising the suite of measures included under the Energy Star Retail Products program to align with the current suite of the ESRPP offering. So that is just aligning the program with ESRPP and continuing to leverage the ESRPP program going forward with retailers. Other changes to these sub-programs includes that we're proposing to add new measure offerings across the sub-programs, including even the lighting sub-program. I know we talk a lot about the opportunity for participation and savings decreasing in lighting. That is really driven by the standard LED bulbs. And what we've done is we've looked at additional opportunities that are supported both in the technical reference manual and have been successful with other utilities. And these include Energy Star rated ceiling fans, LED holiday lights, as well as LED desk and table lamps. Again, to highlight an element of our program that helps to achieve participation of customers who may be, faced with financial constraints. I will highlight that we have heard that the LED desk and table lamps are a measure that are often sold in dollar stores, I'll say smaller type retailers, who might have more customers who are shopping in those stores that might be income challenged. So I think that's another element that helps to achieve participation, even recognizing the current pressure on our programs with customer participation and customer potential, financial challenges with participation. Okay, turning to slide 10.
Hang on. Can you go back a second? Ask you a quick question. Consumer electronics, aren't those purchases more driven by the technology these days? And I guess I have convinced me that that's not going to be a free rider program.
Yeah, consumer electronics is really no different than appliance rebates or other retail products. These are Energy Star rated monitors, TVs, I'm drawing a blank, computers, monitors, TVs, even like printing equipment, imaging devices. And the program leverages Energy Star and promotes the purchase of the Energy Star product. So it's effectively the same as appliance rebates, where we're promoting for the customer through the program to purchase the higher efficiency unit versus the standard efficiency unit. I will comment that Energy Star has, I'm sorry?
I appreciate the explanation, but I just have a concern that unlike appliances, which are largely driven by price point, I think consumer electronics are not, I believe, and maybe I'm wrong, The consumer electronics are driven by technology, not by price point. You see it with these little neat tools. Every time you get a new one comes out, people run to it, and it's not price point, it's technology. So I think they're a little different than appliances.
I will comment that it is surprising to me that this is I really have to highlight the Energy Star certification, and Energy Star has recently updated several of the standards of consumer electronics in order to ensure that their certification is to the higher efficient products that are available in that space. So again, similar to appliance rebates as an example, it's motivating the customer to move to that higher efficiency product.
Thank you, Mr. Chairman.
Okay, turning to slide 10, this slide provides an overview of our home retrofit program. As shown on this slide, the home retrofit program includes the Quick Home Energy Checkup, school education, energy efficiency kits, and home performance with Energy Star and HVAC rebate sub-programs. This program and sub-programs are a continuation of our existing program and sub-programs, and as you can see from the following slide and from the key changes on this slide, includes changes to improve the offering to our customers. Some of the more notable key changes that I want to highlight first is that we are adding an online audit option to our QHEC sub-program to provide an incremental audit option for customer participation. In keeping with some of my earlier comments around designing our plan and our projections and our portfolio of programs to achieve customer participation, again, recognizing the current pandemic and the current challenges facing customers, we feel this is a no-brainer in order really to reach out, promote, engage, educate, and hopefully to not only help the customer become more efficient through what they learn through the online audit, but also to cross-promote the other opportunities to them if they're able to pursue other opportunities. The second notable key change I want to highlight is we are expanding our QHEC sub-program to increase our efforts to target multifamily customer participation. This is something that we have been doing with the QHEC program, but we're putting more focus on it. And again, the QHEC program is a great offering to engage customers and provide education, also to achieve energy savings at the time of the walkthrough audit, but also, again, to cross-promote the other opportunities to them. This is a program that really helps to achieve participation across the portfolio. The third key change I want to highlight is we are proposing to revise our energy efficiency kit sub-program to target new movers. And this is something that we've learned from, or something that we've taken from the success of other utilities. And the concept here is upon moving to a new residence, we'll send the customer a welcome kit that includes the easy to install low-cost measures with information regarding program opportunities available to them. So before I go on, I just want to comment, of the three enhancements I just communicated, the online audit, the QHEC, and the energy efficiency kit. These are all no-cost options to the customer. So this is, again, recognizing the challenges facing customers today. These are great program offerings to achieve participation, achieve energy savings, educate the customer, and hopefully help the customer, both with things that they can do that's no cost through changes that they can make on their own, but also to promote other opportunities to them. The other thing that we're looking at doing is targeting low-income customers through food banks. That is something that we have been doing, and we plan to continue to do that, but also look at other opportunities to target limited income customers. And similar to EE kits, when we provide low-income customers with products through food banks, we do provide additional information regarding other program opportunities available to them, as well as the DHCD program offerings. And the other changes on this slide includes that we are adding new measures to the HVAC sub-program.
Mr. Chairman, may I ask a question?
Please.
Mr. Miller, I just wanted to find out if you've considered, your company's considered financing options at all. There was a great presentation yesterday about the Maryland Clean Energy Center. And if you have considered them, do you think that there may be opportunities to enhance the adoption of measures, particularly for the HVAC program and the home performance with Energy Star?
Thank you, Commissioner Richard. That's a very good question. And Potomac Edison, we have actively participated on the finance working group over the past few years. And that's a very tough and difficult question to answer. And that's a very tough and difficult question, I think, for us collectively to get our hands around. We are concerned with customer bill impacts and the rising surcharge to customers. And one of the concerns that we have is, several of the financing proposals that were submitted and reviewed by the working group appear to have a lot of potential cost associated with them. And, on one hand, we do acknowledge that financing programs to varying degrees are available in the industry and do achieve customer participation. I think the key question really, though, is what's the incremental benefit of the financing program? And that's the challenging part is getting to, it's not that the program provided 100 loans, it's of the 100 loans that it provided, how many of those customers had access to capital or other financing opportunities in order to undertake the investment to get to really what's the true benefit of the offering. And that's, the concern that the joint utilities raised with the cost associated with providing financing really gets down to not having a really good feel for what the, I'll say the cost benefit analysis is of that when you look at when you look at trying to identify what's the uptick as a result of offering it to customers. And I believe that's ultimately why we landed that of the options that were presented, the Maryland Clean Energy Center program does appear to be the most cost effective of the options because it's pretty much ready to go with the absence of some of the details that need to be worked out and resolved. And of the options that was presented, it appears to be the least cost.
Do you think a pilot, as was suggested yesterday, might be able to answer some of the questions you had about the incremental benefits?
I think a pilot potentially, if it's designed right, would be able to inform the potential benefits. I'm drawing a blank on the number of loans that the pilot proposed by MCEC would support to know whether that would be of a sufficient size in order to truly gain from it, what's the incremental benefits. But it's hard to say that a pilot wouldn't, provide insights that would be insightful.
Great. Thank you, Mr. Miller, and thank you, Mr. Chairman.
Mr. Miller, if you'd like to proceed.
Okay, thank you. Turning to slide 11, this slide provides a summary of our behavioral and our Energy Star for New Homes programs. A few things that I want to highlight is for the behavioral program, we worked with our implementation provider to redesign the program based on our current customer base and usage to optimize customer participation and savings. And to answer one of the questions earlier is the end result of this program is actually the participation projections that we are proposing as part of our new plan is actually equivalent to what our current participation projections were for our current plan, and actually a little bit less. However, the program does achieve a little bit more participation, and I apologize. I might be making this confusing. So I'll take a step back. and try to start over. I apologize. The projections under our current plan for Potomac Edison was about 115,000 customers in the treatment group. What we're projecting for our plan going forward for 21 to 23, I think, is about 114,000 customers per year, and that's roughly an average number. There is some year-over-year changes. So we are projecting a decrease from our current approved program projections. What we have seen under our current program, though, is due to normal customer attrition. The current participation in this program is closer in the 100 to 105,000 customer range. So to answer the question, we are projecting a pretty much a equivalent participation level going forward. However, it is a slight increase from our current participation of treatment group customers. And I really didn't do a good job on that, so I apologize. But the one thing I want to take a step back and highlight is when I say that we redesigned the program, the goal was, let's look at our entire customer base, look at usage, look at the history requirements associated with the program in order to target the customers for participation. And that's what we did in designing this plan. Other ways that we have optimized the program or plan to optimize the program is that we are planning to continue the revised home energy report messaging that we are currently piloting to target an improved customer experience and engagement in the program. And what I'm referring to is, I think we're all familiar with the existing neighbor comparisons, and different people at different times have different views about that neighbor comparison. But what we're currently piloting is alternative messaging, where it looks more at an energy benchmark and energy zone, and also incorporates some community type messaging associated with the home energy report. So we're really looking at trying to improve our customer engagement and customer experience in the program. The next program. I'm sorry. Okay, I was getting feedback unless there was a question.
Yeah, I'll go ahead and ask my question now because it deals with the behavior. Mr. Miller, could you tell me how much the behavioral program changed in terms of its percentage of the entire portfolio, and how much the budget changed for behavioral programs?
I do have that information handy. It might take me a minute to pull it, if that's okay.
I can wait. I can wait till maybe we get further along, if that's okay with
Hey, Ed, why don't you take a quick look? But I think I was looking it up because Chairman O'Donnell, you kind of gave a heads up that you may ask a question about behavioral. So I was doing a little looking at some numbers here. I believe it represents about 18% of the portfolio savings. And the budget, I will indicate, I got some insights that our budgetary cost customer is decreasing from the current plan cycle to the next plan cycle. And that's tied to some of the enhancements that Mr. Miller was referencing. And
how much of the, I'm sorry, how much did that 18% of the portfolio change from the previous, do you know?
I do not have the candy in terms of how much it changed, just that it's 18% of the projected savings of the new plan. But I think, Mr. Miller indicated we were targeting 115,000 participants in the current plan and 114,000 in the new plan. And again, I think from a cost standpoint, we're going from about $9.60 per customer down to a little over $8 per customer. But I do not have the comparison handy from the current plan.
Thank you.
Should I continue? I'm sorry.
Please.
Okay, thank you. The next program on this slide that I would like to highlight is the New Homes program. And for this program, we adopted the recommendations of the Electric and Natural Gas Working Group report that was filed in April of this year and considered by the Commission earlier this year. The recommendation is to include additive incentive opportunities for the new home construction to target higher efficiency central air conditioners, heat pumps, and heat pump water heaters, as well as providing incentives for the construction of higher performance tiers exceeding the Energy Star certification for the program. Okay, turning to slide 12. This slide summarizes the Energy Solutions for Business and the Small Business Solutions programs. The Energy Solutions for Business program includes the custom, the prescriptive, and the retro-commissioning building operations sub-programs. The custom and the prescriptive sub-programs are a continuation of the existing program with the addition of new measure offerings. The key change to the Energy Solutions for Business program is adding a new sub-program for retro-commissioning and building operations that includes expanded measure opportunities from our current plan to improve building energy performance for our commercial and industrial customers. This is a sub-program that provides customer outreach and engagement and primarily includes targeting building up and retro-commissioning opportunities for customers. So this is another exciting opportunity another opportunity that I'm excited about in our portfolio, as this really helps to target and achieve customers that we haven't been targeting and achieving the participation in for these types of opportunities. The last program on the slide is the Small Business Solutions program, which is a continuation of the existing program. The one thing I want to communicate in a little bit more detail with this program is I think it's well known that small business customers are a hard to reach customer sector. They are a population of businesses that often face a lot of constraints, resource constraints to participate in programs, energy efficiency programs. They have limited time to explore and investigate what their opportunities are, or to even learn what their opportunities are. So there's a time and a educational constraint to participation. The other constraint to participation is the financial ability to participate and undertake energy efficiency improvements. And I want to highlight this is kind of a program. I don't want to say it's near and dear to my heart, but I have two friends who actually have small businesses, and actually both of them are little restaurants, which is one of the opportunities that this program targets. And I will say for both of them, I see them working in their restaurant pretty much 7 days a week. They're there sun up to bedtime, it seems like. And I mean, all of their time is really spent with just running the business and arranging the food orders and the deliveries and the products and just the day-to-day hassles with that type of business. So I want to highlight that this really is another program that's really important to serving our customers. And again, recognizing the current challenges, we believe this is an important program, both for our customers as well for us. As with all the other programs, when we were developing this program, we collaborated with the other EmPOWER utilities throughout the entire process, just seeking and discussing improvement opportunities. Our discussions were practically endless. For this program specifically, we benchmarked small business programs in the industry, and we ended up developing a coordinated proposal with both Baltimore Gas and Electric and the PHI companies to expand this program to target, instead of from up to 60 kW to up to 100 kW. And what we identified in our benchmarking is that small business programs in the industry often target customers that are in the range of 100 kW to 350 kW. And they really seem to land around a typical or the majority of the offerings that we identified were more in the 200 kW range. So we believe that increasing the program cap really helps to improve this program. Again, recognizing that this is a hard to reach customer sector due to the constraints that I communicated a little bit before. To further comment, expanding this program does help to promote small business customer participation in our other programs. This is a customer engaging program. We go into the customer, we identify the opportunities, we educate them. There are eligible measures that are installed through this program, through the incentive structure of this program, but there's many more opportunities that are available through our prescriptive program. So this helps to not only address the issues that the customer has with time and resource and financial constraints to participation, but it provides education on other opportunities as well. And this is something that helps to cross-promote the other opportunities under this program. I also would like to address one of staff's comments. Staff rates concerns regarding us providing measures at no cost, and I will acknowledge that the language in our program description probably wasn't as clear as it should have been. So I do want to respond to staff's comment and confirm with staff that our program design only proposes to provide simple low-cost measures at no cost to support the customer engagement and participation, and that really the direct install retrofit projects are entirely covered and handled through the incentive strategy of this program, where the program pays up to 80% with the customer paying the balance of the cost for the eligible installations. Turning to slide 13, this slide provides a summary of the other programs included in our plan. The streetlights, the transformers, and the T&D upgrade sub-programs are all continuing programs from the current plan. These are program offerings where we effectively are capturing the energy savings from other company initiatives that are funded outside of the EmPOWER surcharge. Okay, turning to slide 14. Before I finish our presentation for today, I would like to highlight, and I know we've had a couple discussions on this already, that achieving the goals for 2021 to 2023 are going to be very challenging. And we attempted today to communicate some of the key strategies that we have that we believe are needed to help support us meeting our goals. The key strategies include continuing and improving the budget and incentive flexibility that we reviewed earlier, that really puts the utilities in the best position to react timely and effectively to changing market conditions and program performance. The question on the program budget transfers, as an example, that really helps us to maintain momentum. If we have programs that are exceeding projections where we need a budget transfer in order for them to continue, the last thing we would want to do is to suspend a program, halt performance, disrupt the market, and then lose the opportunity. So the budget and incentive flexibility is something that we really highlight as being needed, especially in the current climate. Next is targeting and including savings opportunities in a balanced manner to provide ample opportunities while balancing risk across customer sectors. I think from our presentation today, you can see that we virtually touched each and every program. And we did an exhaustive research and collaboration in order to really look for all the opportunities that we can. We did that across the entire sector, and we always challenge ourselves to make sure that we have a plan that's balanced across sectors, just recognizing the challenges to each of the programs and also to what customers are facing. This rolls into the third strategy, which is listed, which is, including new or expanded program opportunities to provide more opportunities for customer participation. And I believe I've highlighted a little bit earlier some of the strategies and opportunities that we included that really help customers who may not be in a position to, have or to expand opportunities to customers who may not have the budget or ability to participate with some of the offerings that we are providing that are no or low cost to the customer. Last and not least is, something that we do when we develop our plans is really leveraging the experience and the input, both our input, but also our affiliates in other states, our peer utilities, both in Maryland and other states, input from stakeholders and our consultants, our implementation vendors to improve our programs. And we really strive to solicit and leverage all that information as we develop our portfolio of programs. At this time, I would just like to thank you for the opportunity to present our plan to you. We are looking forward to working collaboratively with all the stakeholders to meet the aggressive EmPOWER Maryland goals. Thank you.
Thank you, Mr. Miller. The Potomac Edison team. I believe we could take down the slide deck at this time. I recognize how much effort the utility has put into developing all these programs, and never ceases to amaze me how many different EmPOWER programs there are, aside from the more ubiquitous light bulb rebates that you may see at Home Depot or at Costco. It strikes me that as the proposed budget for Potomac Edison increases to new highs over the next 3 years, I think it's 46, 49, and 53 million. We heard from Mr. Tereski earlier that savings from the residential sector for each of the next 3 years will continue to decrease as the program costing continues to increase. I recognize that commercial and industrial customers will see enhanced savings. As we're on the eve of this next 3-year cycle, which would be the 5th 3-year cycle established by law, I'll ask Mr. Tereski, are we seeing a point of diminishing returns? We've gone from replacing light bulbs to now we're building new houses, and soon we'll hear from the fuel cell and geothermal developers. Are the costs getting too great in terms of the benefits that are provided? I recognize that we're still meeting the cost effectiveness thresholds, but is it getting harder to do so?
Thank you, Chairman, for that question. And I do believe, even though, like you mentioned, we are still meeting the total resource cost effectiveness test results, I do believe you are seeing a projected decline in the magnitude of the benefits in relation to the costs. So there's a declining cost effectiveness. Even though it's still positive, it is declining over time. I do think that the goals that we're faced with in EmPOWER at 2% per year are really pushing the envelope in terms of requiring you to go further up the curve in terms of marginal effectiveness. So there's a balancing there in terms of at what level is appropriate. And I think we're faced with these 2% objectives, and I do know if you look around the industry, those are probably in the top 5 of the country in terms of the challenge that we're faced with. And again, as you mentioned, the lower hanging fruit in terms of like residential lighting savings are going to diminish over time, and that's going to cause you to have to substitute more costly measures and to provide higher levels of incentives to push the participation levels up to the levels that are needed to be there. So I do think that there's a balancing, and obviously a key policy question for the state in terms of going forward.
Thank you. I know your utility went first of the 6 program administrators, but it does illustrate the problem that, particularly in some sectors, we're seeing less bang for the buck, and it's getting harder to squeeze out those efficiencies at at a lower price point. Again, I appreciate the presentation. Any other commissioners? Commissioner Herman?
Thank you.
And thank you for the presentation. It's been very helpful. So I believe it was MEA who said we should be looking more at individual programs and the cost effectiveness of individual programs rather than relying, just solely on the total portfolio. Do you have a response to that suggestion?
I do if my colleagues don't.
Go ahead, Jeff.
This is Mr. Trout. You knew you couldn't get through 4 days of hearings without something from me. And I apologize in advance. I've stayed on mute because there's construction going on in my house. We're finally rebuilding from the flood, and they chose today to start the serious banging. But the reason to look at the portfolio, whether the sub-portfolio level, the residential portfolio and the C&I portfolio, is to maintain a very important goal that the Commission and I believe the General Assembly set from the very outset, and that we have consistently pursued through the entire life of EmPOWER, which is to make these opportunities available to as broad a group of our customers as we can. And to do that, to be blunt, you're going to have to do a few programs that are less cost effective on their own than others are. It's a public policy trade-off between efficiency of implementation versus equity and outreach across the population and across the customer base. That's been the Commission's philosophy. That's been the utilities' philosophy. My understanding is that it's the General Assembly's general direction to us all, and that's why we have done it that way from the outset. And I would respectfully recommend that unless the Commission or the General Assembly directed us otherwise, that we continue to do it that way.
Thank you, Mr. Trout. Always good to hear from you. So you might want to go on mute, Mr. Trout. Thanks. So
everybody with open mic could go on mute. Mr. Miller, Mr. Tureski. Thank you.
Okay. So my next question is, the only program that's, I would say really not cost effective. Most of yours are close to one if they don't exceed one. Is this for residential, the Energy Star appliance rebates? So why do you think it's important that we continue to do this kind of rebate if it's not cost effective?
I will comment that the residential appliance rebate program offering, that's a sub-program that includes the Energy Star retail products program components, as well as other measure opportunities within it that aren't part of ESRPP program. It is a offering that engages retailers with promoting energy efficient products to customers. And it also is an offering that let's face it, every customer has appliances that they're buying. The cost effectiveness of that program is really is challenged, and one of the key drivers of the cost effectiveness of it is the ESRPP component of it. Really hasn't gone through an evaluation process yet. I know the most recent evaluation that's been done relied on I'll say, evaluation results from an offering in another utility, I believe maybe in Chicago as the example. But I come back to, and it's kind of dovetails with what Mr. Trout was communicating, is that, this is an offering that engages retailers to promote energy efficiency. It's an offering that engages customers because all of us and all of our customers are buying appliances. And, this program does achieve and motivate the purchase of the energy efficient appliance.
So this is a midstream program.
The ERPP program is a midstream program. That's correct.
Okay, and in your view, because in the last cycle we really kind of moved from customer incentives to midstream programs, where the incentive didn't go directly to the customer. So has that been a successful move? And is that something that you anticipate being successful in the future?
I think it's, first off, I think it's hard to argue against the Energy Star brand. And I love the analysis that Energy Star does in order to look at what products that they feel need to have that extra emphasis in order to engage the retailers and the customers with purchase. Just over the past 2 or 3 years, we've seen them remove measures from the program, and we've seen them add measures to the program, which really tells you that Energy Star is actively managing the products that they are targeting, that they believe really needs that type of program to engage the retailers, to ensure the stocking of the products, to ensure the promotion of the products in stores, the training of associates who are selling the products in stores. So in that sense, I do believe that it is successful, recognizing again how Energy Star is actively adding measures and removing measures to the program, and really motivating the retailers. Let's face it, if the retailers aren't stocking the products and aren't promoting them in the stores or helping customers to make those measures prominent for customers to buy them, you would have a lot less, in my opinion, a lot less products that would be energy efficient products that would be purchased by customers.
Okay, thank you very much. Appreciate the answers. Thank you, Mr. Chairman.
Commissioner Richard.
Thank you, Mr. Chairman. And again, I want to thank you for your presentations this morning, or I guess this afternoon now, sorry. OPC and NEA remind us that we need to do better as a state with all the programs in delivering services and delivering these programs to low-income residents. I wonder if you could highlight for me how you're doing that in your service territory, and also ways that you are coordinating with DHCD, and again, to make sure that those programs are well promoted.
Thank you, Commissioner Richard, for the question. In developing our plans, we collaborated extensively with DHCD throughout the entire plan development process. And we really looked at, I'll say, 3 areas as we went through the process and working with them. We looked at how we're currently collaborating with them, how we're currently supporting their program offerings. We looked at what we're currently doing in order to promote their programs. And then as we developed our programs, we also looked at ways that we could also help to identify and target low-income participation. It was I will say a extensive effort to collaborate with DHCD. Some of the things that we have been doing and that we plan to continue doing in collaborating and working with DHCD is we do provide them with customer data that helps them to target their programs. We provide them data that helps them to deliver their programs. We provide them with customers who have been disconnected or reconnected from service. recognizing that they could be a potential limited income customer. And we also provide them reports that really strives to help them to identify potential low income customers for them to target. So that's, that is collaboration that we have been doing, that we will continue to do in order to just work with them, help them in the delivery of their programs where we can, the necessary customer data, and also to help them, with helping to identify and target low-income customers. Similarly, we looked at everything that we're currently doing in order to support low-income participation. What we are currently doing and what we plan to continue to do is to promote low-income participation in the DHCD programs, as well as in our programs and practically every single opportunity that we have. We have a link to their website under our website where we have our energy efficiency program information, where we're promoting both our programs, but also their programs to customers. We mail a letter annually to high usage low income customers to promote the low income programs, and we plan to continue to do that. We provide marketing materials in conjunction with the delivery of our programs to help customers to identify the limited income opportunities available to them. We participate in community events, and we include their marketing information when we're participating in community events. And I know one of the topics that came up yesterday is regarding the BSmart program. And we do provide and promote the BSmart financing program from DHCD. Through our Home Performance with Energy Start program, we include both marketing materials for it. We have it linked on our program website. And we also, when we meet with contractors and we train contractors for participation in our program, we also promote and provide the information on the BSmart program so that the contractors who are delivering the program are trained and educated and can promote it to customers. Some of the new things that we identified through our collaboration, I think you heard about one of them yesterday, is that we are now planning that we're going to include both bill inserts and also a bill message on our electric bill, and with our electric bill 1 to 2 times a year. And I believe the communication yesterday was that we're in the process of actually scheduling that first bill message. That's going to go to all customers, and again, it's going to promote the DHCD program offerings, to our limited income customers. So I want to highlight a lot of time, a lot of discussions, and a lot of real thought processes gone into both helping us to really, as closely as we can, to target, to achieve, to deliver services and help our low-income customers. Looking to the future, when we designed our program portfolio, there's a few things that we specifically included also to try to help to identify, target low-income participation, either in our programs or the DHCD programs. The first one would be for energy efficient products. For lighting, is we plan to continue to participate in food banks. We will be looking at other nonprofit agencies in order to look at other opportunities to distribute, I'll say the food bank kits to the low-income customer. What I really like about that approach is that puts the information in the customer's hands. It includes the marketing information. It's something they can look at. They don't have to go to a website or do a lot of research to find out the program opportunities. So that's one of the ways that we'll be, targeting low-income participation. Secondly, in our delivery of our school education program, we plan to work with our implementation vendor to target schools for participation where available that are in areas that might have higher population of low to moderate income customers for participation. I mentioned earlier in my presentation our energy efficiency kit offering. We are planning to include the information on the DHC programs in conjunction with that. So every new mover into our territory will be receiving a welcome kit, and it will include the information on DHCD's programs and limited income program opportunities available to customers. And the last thing, and I probably failed to mention it earlier, is in our redesign of our behavioral program, we specifically included a focus on both our known low-income customers. We will be providing a customized home energy report, which will include low to no cost information, to help customers, identify opportunities for energy efficiency improvements, for other energy efficiency program opportunities available to them. But we're also planning on adding a marketing module to the offering, where if the customer is a low-income customer that we know of, or we're also going to do data analytics through our implementation vendor, where we will identify customers with a high energy burden and target them with marketing information, again, to promote the DHCD offerings. So that rounds out the three groups of information, but I just want to emphasize that we put a lot of time and effort in both collaborating with DHCD and designing our program portfolio to serve and to identify, target, and serve our limited income customers.
Thank you, Mr. Miller. I'm very impressed by your answer. Thank you, Mr. Chairman.
Thank you. A very comprehensive response indeed. All right, we will conclude this portion of the hearing. Thank you to Potomac Edison. At this point, we will take a lunch recess until 1:45 this afternoon, at which time we'll hear the presentation from the Washington Gas Light Company. You'll also have 1.5 hours to present. I'll see everybody back here at 1:45. Thank you.
Thank you. Thank you.
We'll be back on the record in approximately 1 minute. Welcome back from the lunch recess. We're back on the record. At this point, we will hear the presentation from the Washington Gas Light Company. If you're prepared to go, please state your name for the record.
Thank you, Mr. Chairman and Commissioners. Good afternoon. My name is Josh McClellan. I am the manager for the energy efficiency programs here at Washington Gas. Always a pleasure and opportunity to present our plan for the next program cycle. I am getting notifications that I do have low bandwidth, so I'm going to stop my video for now, just to cut off any potential bandwidth issues we may run into during the presentation. And just for everyone's awareness, I also have Andrew Lawson on the line, who's manager with our regulatory affairs, and Stephen Burr, who's our manager for reporting and analytics for our energy efficiency programs here. And Mr. Chairman, please let me know if you can see my screen.
Mr. McClellan, it looks great. Thank you.
Okay, sir. Okay, good afternoon, Mr. Chairman and Commissioners. Again, Josh McClellan with Washington Gas, and I'm proud to present our plan for the next three EmPOWER Maryland program cycle for 2021 through 2023. I'm starting off, I just want to take a moment to kind of look at the journey that Washington Gas has gone through since we started and stepped foot into the EmPOWER Maryland arena in 2015. And you can see that we've seen a continued success year over year and cycle over cycle ever since we launched our programs. A lot of our customer base and stakeholders are seeing the value in what these gas rebate programs bring to EmPOWER Maryland. And you can see that 21 through 23 is going to be our largest program to date in terms of both the benefits and the total investment that are being offered to our customers. And again, another reason that, we're seeing this is that we are right now is that we've seen a little bit of program maturity happening during the 2018 through 2020 cycle, which allows us to build on some of the successes that we've seen so far, capitalize on that, and provide and max value through these programs. Just a quick note about our cost effectiveness. This is definitely something that is a big priority for us, on top of being a requirement to run programs in EmPOWER Maryland. But just a quick overview that you can see that our portfolio costs, we are cost effective across the board, and for all of our customer segments, safe, income qualified. Moving on to some of the guiding principles that we've used during our program planning and design process. Just wanted to lift the hood up a little bit for everybody to kind of just show you what we thought about and some of the things that we used and considered and during planning and building of this proposal. So one of the first things that we want to really emphasize on is having realistic goals. I'm sure as the commissioners know, some of the goals developed for 2018 through 2020 were a little bit on the higher side and a little bit outside of the reach of what the market has dictated so far and what we've seen during the current program cycle. And so what we've done is we used a lot of the historical performance that we've seen so far to kind of gauge what the program in 2018 through 2020 was a cycle in which we deliver these programs at the scale that we're currently seeing them now. So we have a couple of years under our belt to really look at the information, the participation, and performance of these programs, and has been a valuable piece in determining what the next 3 years are going to look like. On top of that, we wanted to make sure that the impacts of COVID-19 were considered in our program and planning design process. To answer your question, Commissioner O'Donnell, that you had about certain COVID-19 impacts impacting the budget, I do believe we have a similar stance in terms of Potomac Edison, that there was an indirect impact towards the participation count, and that was considered, especially in 2021 of the next program cycle. So if we're anticipating lower participation amounts, that in turn means we're going to have lesser budgets, and so that's how the COVID-19 has impacted that, just to make sure that we're staying within the parameters of cost effectiveness. And so that was definitely something we considered. And on the other side of that coin is we want to make sure that we are maximizing the value of these programs and keeping our costs relatively low. And so that always has gone into every single aspect of our program planning. Another big piece is to find out, our programs, we do understand that they're not entirely comprehensive and there might be gaps. And so we definitely want to make sure that this cycle addressed any of those gaps that our current programs may have. And we just wanted to make sure that we are casting a wider net and providing value and solutions for all of our entire customer base. Another thing that we considered as well is cost effectiveness. The main requirement is that our programs are cost effective at the portfolio level. Since we aren't beholden to the mandated goal, a 2% goal, we wanted to strive to make sure that that we were cost effective at the program level. And so, with the exception of the limited income programs, we were able to achieve that by keeping our operating costs and our non-incentive costs lower than anticipated, and we were able to keep cost effective at the program level. Commissioner O'Donnell, yes, sir.
Can I ask you a question about cost effectiveness? It looked like on your previous slide or two, it looked like fuel and equipment savings was about 39 million, but investment was 51 million. And I'm using rough numbers, but yeah, there. So if you add the fuel savings and equipment savings, it looks like about 39 million, and you have total investments 51 million. How is that cost effective? Help me.
Right. So the equipment savings cost is synonymous with incentive dollars. And so out of the 51.8 million that you see at the bottom of the total investment, 31.4 million is allocated towards incentive dollars going out to our customers. And so in terms of the total, I'm sorry.
I understand the slide now. I was misreading the slide. Okay, thank you.
Okay. Moving on to our income qualified customers. One of the things that we wanted to definitely focus on for this program cycle is to provide additional value and resources to the income eligible in our more vulnerable communities throughout Maryland. And so one of the ways that's taking shape for the next cycle is that we're allocating more funding towards the DHCD suite of programs, which we'll touch on lightly later on in this presentation, and of course with DHCD's presentation tomorrow. But we're just very excited and proud of the fact that we see the importance of this, and we wanted to allocate more funding and resource to these programs and just build on the success that we've had with our relationship with DHCD. And just to give you a quick frame of reference, I think for the 2018 through 2020 cycle, we allocated about 14% of our budget towards low-income programs, and for the 21 through 23 cycle, we're at about 26% of our budget is going towards these low-income programs. On top of DHCD through their programs, we also want to make sure that our market rate programs have functionality that can reach and engage with our income qualified folks. So we want to make sure that we're taking and providing value a step beyond the traditional core programs that DHCD provides. And another component of that as well is we want to make sure that we're casting a very wide net and we're actually reaching these customers and providing the messaging and communication that resonates with them and ultimately will help them reduce their energy burdens and expand participation throughout our portfolio. Another piece too is that, we've had various mixed results with our program performance over the past cycle, but we definitely had a few programs that we would consider very successful, and so we make sure that we're building upon those successes in the cycle and continue to maximize value in those programs. Another piece too, and this ties into sort of our gap analysis here, is there's a lot of great opportunities out there to add further value and to look into technologies and new program mechanisms. And so we're really excited to expand and focus more on our pilot programs for this cycle. And so that includes testing measures and programs that can promote greater gas savings. And of course, ratepayer impacts is something that we're always looking at, and again, going back to my previous comment, we just want to make sure that we're maximizing the value of our programs and the benefits that our customers receive, and weigh that against the cost to operate these programs. And last, and certainly not least, and this is probably still the elephant in the room, we're doing everything we can and being proactive right now to ensure that we're not burdened with any delays for the next cycle launch for our new suite of programs. And so that means, we're working internally with our procurement folks and our supply chain management and all the things that we identified that could result in the delay. We're being proactive and cutting that off ahead of commission approval now. So we're ready to go on January 1. Here's just a quick high-level overview of our program plan for 21 through 23. It's broken down into 4 main categories. You can see here with residential programs, commercial programs, income qualified, which ties to GHGD's suite of proposed programs, and then a new host of pilot programs that we're looking into and seeking approval for. And I'll get into more detail on these in subsequent slides. So we'll go ahead and jump right into the specific program overview. And we'll go ahead and start with our residential programs here. And starting off with existing homes. So our existing home program is our residential prescriptive program and provides rebates for high efficiency gas equipment for homeowners. And that includes space heating, water heating, and appliances. This also includes an online home energy profile that's available to our residential customers. And then the availability of do-it-yourself home energy kits that are available to our customers. Just to quickly touch on some of the key updates. And so actually, before I start talking about the key updates, I wanted just provide a little context to what the program looks like compared to the current cycle. And so this program received sort of a right sizing as part of the program design process, meaning there was a significant reduction when compared to this cycle forecast, and they're more aligned to the reported savings during this cycle. And so we are anticipating increased participation to the next, and that's mainly due to additional measures coming online, such as combination or hybrid systems, which are more prevalent in the multifamily space. We also are including HVAC tune-ups, which are aiming to extend the life and the efficiency of existing gas equipment. Another piece that we're really excited about is including the point of purchase feature for water heating equipment and dryers. And so traditionally, you only had to work through a participating contractor, but now as a customer, you'll be able to go to a big box retail store such as Home Depot and receive rebates through that method as well. So it's just another avenue through which our customers can participate. Another piece too is that we've seen a lot of popularity with the home energy kits, especially during these times when some people may not be able to afford to participate or purchase gas equipment. Folks are looking for low to no cost solutions, and these savings kits provide that to our customer base. On top of that, we are, we always go back to the drawing board and try to find new and innovative and effective ways to communicate and market our programs to our customers. And also we are seeing, expanding our contractor network. I think in the beginning, we started with roughly 35 to 40 contractors, and we're pushing 150 contractors and that are either gas fitters, plumbers, or HVAC techs participating in our contractor network. Moving on to the new home construction program. So a quick overview, this program provides rebates for high efficiency gas equipment and certifications to home builders and developers for qualified new construction projects. So some of the key updates here is the new construction program has recently been delivered through what we call the coordinated whole home program model. And so we are proposing that that model be the main and primary program moving forward into the next program cycle. I know there was a specific question in terms of data requests. If the current structure is there is a coordinated program and a specific just equipment measure program are going to be offered in parallel with one another. And moving forward, we're just going to have the coordinated whole home program for the next cycle. So what that program offering is going to entail is providing rebates through a coordinated cost sharing model for the Energy Star new home certification. Also going to include, similar to our existing home program, rebates for the combination or hybrid heating systems, again prevalent in the multifamily sector. And then also include rebates for the high performance tier. And so the two main examples that we've highlighted and that the other utilities have highlighted is the DOE Zero Energy Ready Home and then the Passive House Institute certification. Both have the opportunities to drive deeper savings for both gas and electric. We've always considered our new home construction program as the flagship program of the residential portfolio. And that is on track to exceed both our cycle and annual savings by almost 30% by the end of the year. On top of some of these key updates, we have a broad, we have a little bit more maturity with this program, so we have a broader awareness with the Maryland home builders and property developers, and understanding what we're able to offer. These home builders have a strong builder pipeline that we're able to forecast, a large increase in our participation in savings for the next 3 years. Moving on to our behavioral-based program. So as of right now, we are providing, and what we're doing into the next cycle, providing home energy reports and other online resources that encourage behavior that reduce energy consumption. And so some of the key updates for this program is that we're looking to expand the treatment group from the current count to incorporate all the other customers out there that have the greatest potential to an opportunity for savings. Another piece that we're looking into is also the high bill alert feature, which will allow our customers to make changes in real time and kind of be proactive and making changes ahead of what could be considered a high bill timeframe during peak usage. Another piece too is that we want to that income qualified folks and communities are part of this, and so we want to make sure that there's targeted engagement, since there are a lot of opportunities to provide income qualified or low income communities with energy saving tips that are at no cost. This could be another way to expand and let them know about the available to them, or provide expanded marketing communication that could result in uplift to some of the other low-income resources and programs that are available to them. I know there was a question brought up during Potomac Edison's presentation about relation of savings versus and budget portion compared overall. And so I believe for the 21 through 23, the behavioral-based program is going to entail 4% of the overall budget over the 3-year cycle, and is going to account for roughly 32% of our program savings. And that is on par with what we've seen so far during this program cycle. So that performance is relatively consistent across both cycles. Moving on to the utility coordinated programs. So this aspect that we consider the coordinated programs refers to the current retrofit programs that are currently available through the electric utility programs. And so that's Home Performance with Energy Star, the Home Energy Improvement Program, and the Quick Home Energy Checkup Program. you know, we would, I think, I wouldn't, it wouldn't be too far of a stretch to say, and I could speak on behalf of some of the utilities that we've had good success in running this coordinated model over the past couple of years. And so we're looking to build on that success and continue that into the next 21 through 23 cycle. And that means that the components that we would consider phase 1 and 2 will be essentially extended over the next 3 years. And we have open dialogue and communication with our partner utilities. And so we're always finding ways to explore additional coordination opportunities through either work group activity or those relationships that we have with our utility partners. Moving on to the commercial side. So we'll start with the CN prescriptive program. And so the main gist of this program is to provide rebates for high efficiency gas equipment to all Maryland commercial and industrial customers. And the equipment includes anything from furnaces and boilers, water heaters, and food service and kitchen equipment. And so in terms of how the program is going to be offered, this is the one that has the most substantial change to it, apart from the other programs that we're proposing. And that is that we're looking to combine the existing business and new business program into one offering. And the main reason why we wanted to do this is because we saw that there was just an opportunity to reduce some operating costs to reduce that and be more cost effective. Another piece of it too is this is another exercise that we went through to right size this program and to better align with the previous cycle performance and again to reduce our non-incentive costs. So you're looking at our new construction and existing business program that we're currently offering, and we're to see that as a combined feature for the next cycle. We are estimating a little bit of growth due to our ever expanding service provider network. And we're definitely going to improve our marketing and outreach strategies through this program. And there's additional measures that are going to be available, such as the small business energy kits and building tune-up components. And so we're really excited about this change and some of the new features that are coming online, because beforehand we weren't able to provide a lot of resources to our commercial customers outside of, you know, if they are going to buy a, you know, a relatively expensive piece of high efficiency gas equipment. So having these additional components adds just further value and additional resources that are at lower cost or at no cost to our commercial customers. Moving on to custom business solutions. So this program provides rebates for retrofit projects that yield gas therm savings through various measures. These are typically measures that are not available through our prescriptive program or are larger in scale. And so some of the updates that we've seen or that we want to include for this program is, you know, to build on top of the success that we've seen so far in this program. This is definitely the more successful out of our commercial portfolio of programs. And so we wanted to make sure that there's more inclusiveness involved with this. And so we wanted to replace the project price cap with enhanced review process. You know, there is no longer a set dollar amount, but you know, the higher the rebate is and the larger the product is going to entail a larger amount of scrutiny to make sure that the program or the project is being cost effective. Another piece too is for the smaller and more efficient projects, we're removing some of the barriers so more projects can get through the pipeline, and this is in line with some of the other custom programs that are offered by the electric utilities. Moving on to our income qualified programs. Again, you can see here, these are the lists of programs that are going to be proposed by DHCD. And so our main goal is to just continue implementation with our relationship between us and DHCD into the new cycle, and just to align and support the program plan upon approval. Again, I would like to reiterate, you know, that you know, maximizing value and providing additional funding and support to these programs is something that we focused on and is a priority to us. And you can see that we're going to be allocating over $13 million over the next program cycle to these programs. Next up is our pilot program. I just wanted to a moment to do a precursor here just to talk about where we stand and what our outlook is for our pilot programs. And I alluded to this at the beginning of the conversation, but looking at the pilot programs a little bit differently than we did in the 2018 through 2020 cycle, mainly because, again, this was the first cycle in which we operated these programs at the current scale. And so we wanted to make sure that we were operating those effectively and that did not leave a lot of time to devote hours and resources to finding new opportunities. But now that we have some of that maturation under our belt, and we have these programs that are going to be carried on into the new cycle, either enhanced or with new features, this is going to allow me and my team to find out and look at those other opportunities that are out there, and to drive deeper savings, fill in those program gaps, and add further value to the overall program portfolio. And so because of this, we're excited about some of the opportunities and some things we've identified, and we're excited to share those with you. And so, we're excited to seek the approval and for a more comprehensive list of pilot initiatives that will meet those objectives that I just stated. On top of that, we've also had a little bit of an opportunity to review some of the comments that related to these pilot programs, mainly from PSC staff. And these comments raise results in terms of recommendations, but the overarching theme is that more information is going to be required. And so we are eager to provide both staff and the commission additional information that can better describe the potential value that we see in these initiatives. And we're also aiming to seek guidance from staff to ensure that this additional information is made available through the proper channels. So with that, I'll go ahead and jump into some of the things that we're thinking about with pilot programs. The first thing we want to bring up is the Online Business Energy Advisor. So a quick overview, and this provides online resources and energy consumption insights to commercial customers that encourage energy reducing behavior. And so this is mainly going to be targeted to our small business customer base, but there could be opportunities for medium commercial businesses to be involved as well. But the main features of this is that there is an online customer engagement portal. There's digital energy reports that provide that insight to our customers, and that can help change behaviors and reduce energy consumption. There's also an energy advisor component that we thought was very interesting. There's an actual human being that a person can talk to and help them walk through and go over any options that can help reduce energy consumption. And again, a lot of this is low and no cost solutions, but on top of that, we're able to provide uplifts to other programs. And so if equipment replacement or a retrofit or just tuning up existing equipment is available, they can participate in those programs as well. Another thing too is that the vendor that we've been talking to and building this program with, we wanted to make it a priority that we can verify energy savings through a pretty robust evaluation process. It's definitely going to be part of this plan moving forward. Some of the concerns that came up with this pilot, and rightly so, is there's going to need about 1,000 commercial customers that will need to enroll this to really move forward and get that verified energy savings and provide the value that we're anticipating. And so, a question that may come up is, okay, if we need 1,000 commercial customers, Washington Gas has struggled to get 100 customers into their commercial programs so far on an annual basis. And while underperformance in our commercial programs is definitely a concern, I believe comparing those programs to the features of this Online Business Energy Advisor is a little bit of an apples to oranges scenario here. And the reason why I say that is because we believe that a commercial customer is going to respond and react differently to some features that are at no cost and provide additional resources that the other rebate programs can provide. And so when faced with no cost measures and maybe an energy kit and things that can do now to reduce energy versus a potentially very expensive equipment replacement, we think that reaction and response and the participation could vary, and it could be different between those two offerings. Moving on to virtual commissioning. So the main overview here is we want to establish advisory services that optimize commercial building controls and software platforms that result in gas therm energy savings. And so things that we've seen through so far, through this offering is it is definitely a pay for performance model. And so that means that the costs are going to be relatively low, and incentives or program costs are not going to be an issue unless some savings are verified and realized. Another thing as well that we've seen and we've heard from various vendors is there's an opportunity to combine and identify gas savings through ongoing virtual commissioning programs that are offered through the electric utilities. So it's in part a sort of a coordinated model, but again, the details on how that relationship will work between our pilot program and the electric programs is still ongoing. And so we're going to need to communicate and figure out what that's going to look like with our electric utility partners. Another thing too is, as the program goes on, and if we see that there is a lot of savings to be had in the program, we would very much want to seek the approval of a fully program based on any results that we find over a year or 18 months. Moving on to our midstream programs. So what's happening here is we think there is a lot of potential to stand up a midstream program for natural gas equipment. And so one of the things that we want to do is we want to conduct a study. We want to do additional research to find out if these programs are feasible enough to be stood up in the Maryland market. And this from looking into commercial applications, but it then opened up to see if there's potential for residential applications as well. And so what we're going to do is we need additional information coming in our way, because during the planning process, I would say that we received a minimal amount of input from the folks that we wanted to hear from the most. And so that would mean Maryland equipment distributors across the state and some various vendors and subject matter experts. And so we want to take additional time, provide a little bit of additional resources to see if these programs are in fact feasible. And we wanted to go this route just to be more conservative with our costs and to not fully deliver fully fledged programs with the savings and the benefits not being fully realized. And so we want more information and more time to figure this out. And then based on the results or the findings of that study is to seek approval for a program or to disband our efforts for the remainder of the program cycle. So moving on to LMI, which is low to moderate income locational based savings. Just utilizing improved methods to identify these customers and offer enhanced energy saving measures. And so this is what I alluded to earlier about casting a wider net, identifying those folks and trying to provide them as much value and resources as we can to them. And so that could take place in terms of geographic and census data overlays to help us just better identify these communities, and then incorporate some targeted messaging and outreach that would resonate with those communities, and then provide additional resources through either program uplift into our rebate programs, the low-income programs offered by DHCD, energy kits, or any other way that we can provide value to these communities. And the last two pieces that we're looking at is demand response. I know the commission has called out Washington Gas in the past to see if there's any opportunities for a demand response program to be stood up under EmPOWER Maryland. And so this is definitely a venture that we want to pursue and continue walking down this path to see what's the best program mechanism to stand up and put measures in place that can reduce our peak energy and demand. And so we do understand that some of the other utilities offer a demand response program through their bring your own device model. And so that is something that we're looking into as well. And so we're asking for approval to continue this research and put together a more comprehensive plan. The last piece is talking about advanced technology and more specifically about gas heat pump technology. And so our main objective is to advance the gas heat pump systems by validating these efficiencies and develop mechanisms to help penetrate the market. And so some of the ways that we want to go about doing that is identify and leverage partnerships and maybe even sponsorships with heat pump advocates. And so just, working for a gas utility, you do have exposure to these types of equipment and technologies that are out there. And, I think the main crux of why we want to pursue this is that we have seen gas heat pump technology and the potential energy savings are included with it. And we see it as a great add to the EmPOWER Maryland portfolio. And we think there's, could be opportunities to include this in some kind of commercial and residential application. And so I believe the details of this are not fully defined, but we think just having a little bit of resources to basically push this technology into the market will have great benefits across the board for our portfolio and for just energy efficiency in Maryland. And that wraps up my presentation. And so, Mr. Chairman, I'm happy to answer any questions you or the commissioners have.
Thank you, Mr. McClellan. Perhaps we could take the presentation down at this point.
Sure thing.
Thank you. Very informative presentation. I think you used the word mature up front. I've only been on the commission 2 years, but I've seen the progress that Washington Gas has made over those 2 years in developing its program. Since Washington Gas doesn't have a midstream program stood up right now, you make these rebates directly to the customer. Is that correct?
That's correct.
Okay. So just looking at the prescriptive list, it looked like steam boilers, they receive up to $10,000 in a rebate. Are there any other devices or appliances that receive more than $10,000?
I believe that the boilers are the rebate is issued based on the size of the equipment, so it's a certain dollar amount per 1,000 BTU hours that the system can put out. And so, yeah, I believe that 10,000 is at the higher level of a rebate that can be issued to a customer. I don't have those direct numbers right in front of me, but based on the equipment size, yeah, the rebates can get up there.
Thank you. In terms of some of the other newer appliances that you've included on the list, I saw like chicken rotisserie ovens and other devices. How does the utility determine which new appliances to bring into the program?
So that's a great question, and I appreciate you asking that. And so we've definitely relied on the feedback on some of the service providers and contractors that have participated in our programs in the past. And a lot of those folks do work with small businesses, mainly restaurants, and in the food service space. And so we've taken some of that feedback from them and saw that there could be opportunity to find equipment that can be included into our portfolio as long as we're able to verify the savings. And so examples like that definitely fit that category.
Great, thank you. Let me open it up to my fellow commissioners for questions. Although I've always dreamed of having a Costco-style chicken rotisserie oven in the house.
That would be a great addition to the kitchen for sure.
Commissioner O'Donnell.
Thank you, Mr. Chairman. Ms. McClellan, can you cover the budget costs of those pilots? You talked about the dollars associated with them during the presentation.
So the overall, if I'm sorry, you broke up a little bit there, Commissioner, but I believe your question is the budget amount for the pilot programs. And the overall amount is at $4 million for the 3-year cycle. I do not have a program by program breakdown of that, but I can and show you where those costs break down.
Okay. And I noticed the programmatic budgets were doubling, tripling, quadrupling in some of them programs. What's your current program budget overall for 2018 to 2020, and what will it be 2021 to 2023 all in?
So our current 2018 through 20 budget, just give me a moment to pull that up. So through 2020, our original filed budget is at $32.4 million. And the budget for the 2021 through 23 cycle is at $51.8 million.
Oh, I didn't read that slide wrong previously. Okay. Just well, let me ask you this: you're going to 38% behavioral. What is the percentage in the current 3-year cycle for your behavioral program in terms of savings in the portfolio? You're going from
right. Commissioner O'Donnell. So for the 21 through 23 cycle, we're going to be at 32%. And for the 2018 through 2020 cycle, we were at 34%. So a small decline of 2% for the next cycle.
Okay. All right. Very good. Thank you. Thank you, Mr. Chairman.
Mr. Herman?
Thank you, Mr. Chairman. So, Mr. McClellan, I appreciate your presentation. It does show some what appears to me to be fairly aggressive increases from 20, from the 18 to 20 levels to the 21 to 23. Help me understand why you think you can make those what appear to be aggressive inroads in these savings.
Commissioner Herman, you're referring to the energy savings goals?
Yeah, the goals and the participants and there's just, you're going, you're doubling, tripling, your participants and that sort of thing. So how do you think, how are you going to go about getting there?
Right. No, that's a great question and very relevant for us. I think there's two main things that come to mind is look at the actual, the performance of the 2018 through 2020 cycle so far. It is a substantial jump from what we think we're going to do in the next cycle. And one of the main things that I think about and that I want you to consider is, or I would like the commission to consider is definitely that slow start in 2018 to where we didn't come online until almost October of that year had a detrimental impact on the performance of our programs. So I would say that if we were to start at January 1 of 2018, the performance you see now versus we are planning to achieve in the next cycle, it would still be larger, but that number wouldn't be, the valley between those two numbers would not be as significant as you're probably seeing it now. Another thing too is there's just a lot of new things coming online, a lot of new features, a lot of new pieces of equipment, and that are just really kind of providing that value to the customer base and are filling gaps that our current programs have. And so, and this is all based on the research that we conducted and listened to our stakeholders, listened to our industry partners, listened to our contractors and provider networks, and they helped us fill in those missing pieces to our puzzle. And so those missing pieces carry with them a lot of potential and savings to just the increase that we're anticipating over the next 3 years. And another piece of that too is going back to the low income program as well. We are very excited for what DHCD has to offer, and so and that itself is going to be expanded, at least with our understanding. And so we want to make sure that our funding can expand along with those offerings. And so that is also a pretty large portion of our budget and why it's going to be larger into the next cycle. That brings up Commissioner Herman, I guess, while I do have just another brief note, I brought it up yesterday, and it is about the aligning of DHCD's reporting across all utilities. And so I meant to make a quick note about that when I was covering those programs. But I do want to say that in terms of where we are, WGL would prefer to kind of maintain the current reporting relationship that we have with DHCD. And that's mainly driven from the fact that our relationship with DHCD stands a little bit up from the electric utilities. And so, it's very much more of a vendor client as opposed to the partnerships with the electric utilities. And so that would necessitate a little bit different approach to how we report out our savings. But with that said, any opportunity to improve the reporting or find streamlinings, we're willing to continue that dialogue and define if there's more efficient and better ways to do that reporting. So I just wanted to bring that to your attention.
I appreciate that. Thank you. So what you're saying is you don't have a new implementation contractor this time around, and you're going to really be expanding existing programs, and that will help you avoid the significant delays you had in 2018 into 2019?
That is correct. That is definitely a big piece of why we'll be able to launch on schedule.
Okay. So I was looking at your pilots, and I have to say I was a little confused why you have energy advisors and virtual commissioning, which is also sounded like energy advisors. Why are they different?
So that's a good question. And so I don't think I have a very accurate answer for that as well right now between what for the energy advisor program versus virtual commissioning. I think the way that they go about and providing energy savings is through different methods. I think more on the advisor model, there is opportunities to provide insights and program uplift to commercial programs and equipment upgrades and pushing customers in that direction. Whereas virtual commissioning is taking a look at the existing equipment, the existing controls, and finding ways to optimize those in a better way so they're efficient overall. So that's kind of my interpretation of what the difference is between the two.
Okay. I think I'm stretching my mind back a little ways, but I know that some of the electric companies have energy advisors, but I don't know that they're recovered through EmPOWER funds. So I just wonder if somebody has an energy advisor, they might be thinking that it's something that is an overall energy advisor, not just about energy efficiency.
Right. Again, I know for the program, and this is a similar program that the electric utilities are providing as well. I know it's specific to energy efficiency and driving those savings. I can't really speak to if there's any other kind of energy advising that goes beyond that.
Okay. Thank you, Mr. Chairman.
Seeing no additional questions from commissioners, our thanks to the folks at Washington Gas, particularly Mr. McClellan, for that comprehensive presentation. At this time, we'll take a brief recess, and when we reconvene at 2:45, we'll hear from the general public and various industry stakeholders regarding thoughts on the next three-year program. We're in recess until 2:45 p.m. Okay, before we go back on the record and start the next segment of our hearing, I'd just like to give the folks in the audience who plan to speak advance notice of the order in which I plan to call the parties. We'll begin with the Building Performance Association, followed by Geller Lighting, Bloom Energy, Dandelion Energy, the Maryland Geothermal Association, Lenar Homes, Mr. Sam Jamal, and Mr. Bobby Height. If I did not call your name, there'll be an opportunity at the end for you to speak as well. At this point, we'll go back on the record. This is the final portion of today's agenda, where we'll hear from general public comments and members of particular industries. We'll begin by receiving public comment from the representative from the Building Performance Association. If you could please state and spell your name for the court reporter.
Yes, my name is Kara Saul Rinaldi. It's Kara, K-A-R-A, Saul, S-A-U-L, Rinaldi, R-I-N-A-L-D-I.
Good afternoon, Ms. Rinaldi. We'll just wait one moment as the court reporter logs you in. You're ready to go, Ms. Rinaldi.
Thank you. Thank you, Mr. Chairman and members of the Commission. My name is Kara Saul Rinaldi, and I'm pleased to be representing the Building Performance Association today, where I serve as the Vice President of Government Affairs, Policy, and Programs. BPA is a national trade association representing home performance contractors and other industry stakeholders with more than three decades of experience advancing a home performance industry that delivers improved energy efficiency, health, and environmental building performance. There are several key issues I'd like to speak to today. One, creating a framework for EmPOWER beyond 2023 with a process to revisit cost effectiveness testing. Two, supporting workforce development and job training. Three, advancing healthy home initiatives. 4, addressing the lack of low-cost, accessible residential financing. And 5, ensuring coordination and successful scaling of smart technology initiatives. And many of these are in my written testimony, so I'll be as brief as possible. First, given that the EmPOWER savings mandate ends in 2023, BPA believes that now is a critical time for the Commission to set up a process to determine future goals and also revisit cost-effectiveness testing practices using the National Standard Practice Manual, as we noted in our e-filed comments. The new National Standard Practice Manual for Benefit Cost Test Analysis of Distributed Energy Resources, or NSPM for DERs, published in August, incorporates and expands on the 2017 NSPM for EE to look at a whole range of DERs. As Maryland pursues its clean energy goals, using the NSPM framework can help ensure consistent cost effectiveness principles, methodologies, and assumptions are applied across energy efficiency programs and all other DER types. We strongly urge the Commission to undertake a stakeholder process to A, determine goals for EmPOWER beyond 2023 oriented around state policy, and B, undertake a review of the NSPM through a thoughtful stakeholder process to ensure that cost effectiveness testing is balanced, transparent, replicable, and prioritizes the policy objectives of the state. If it's helpful, BPA and our partners with the National Efficiency Screening Project would be pleased to brief the Commission on how a Maryland benefit cost test could be developed to best meet the needs of ratepayers and policymakers in Maryland. Second, building a skilled workforce is critical to the success of Maryland's energy efficiency programs, and the pandemic and economic crisis we're in have further underlined the urgent need to support training opportunities and also to best leverage the job creation potential of the state's efficiency industry. In our e-filed comments, we offer specific recommendations to advance workforce development across all the utility programs, including advancing online training, focusing on training for industry certifications, and helping existing training programs, including apprenticeship programs, to expand. Third, BPA respectfully urges the Commission to support opportunities for healthy homes initiatives to be tied to energy efficiency programs, as the pandemic has underscored the importance of maintaining safe and healthy indoor environments. Systems that monitor and remediate indoor air quality, as well as building science-based whole home retrofit technologies, can produce substantial long-term health benefits to residents. Considering health benefits in addition to energy savings and allowing these measures to be eligible for energy efficiency funding would make a healthy indoors accessible to more Marylanders. Fourth, there is a need for low cost, low interest, easy to use financing for residential efficiency investments. Contractors in Maryland have noted the existing financing products are associated with higher costs, relatively high interest rates, and/or challenging administrative procedures. And this is a key barrier for homeowner investment. BPA supports the Finance Working Group's assessment that the Maryland Clean Energy Center at the Maryland Clean Energy Center proposal, would help ratepayers invest in efficiency upgrades, especially for the replacement at the time of breakage, when customer cash reserves may be unavailable for such investments, especially for deeper energy efficiency retrofits. We acknowledge the Commission, we encourage the Commission to allocate funds to this proposal in the upcoming cycle. Lastly, BPA is encouraged by the inclusion of smart home pilots and offerings in these filings, which are an important strategy for supporting a clean, reliable, and affordable energy grid. We respectfully recommend that the Commission establish a robust process for coordination across all utilities to share lessons learned and implement best practices over the course of the 2021 to 2023 program cycle. In closing, I want to reiterate BPA's support for robust residential energy efficiency programs and advancement of the home performance industry. We hope Maryland will continue its leadership in energy efficiency and clean energy by starting a process now to establish goals for EmPOWER beyond 2023 and reviewing cost-effectiveness testing using the NSPM for DERs to ensure the test is sound and aligns with those goals. Thank you very much. I appreciate the opportunity.
Thank you, Mr. Rinaldi. Thank you for filing comments last week, as well as those 8 benefit cost principles that were contained in your comments. What we're planning to do this afternoon, if you could stick around for the next hour or so, we'll have a number of the commenters present, and then the commissioners will ask questions of each of them if they have questions.
Thank you very much.
Thank you. At this time, we will turn to the representative or representatives of Geller Lighting Supply Company. And again, if you could please state and spell your name. We will move on to representatives from Bldg Energy.
Good afternoon, Mr. Chairman. Good afternoon. My name is Charles Fox with Bldg Energy. It's CHARLES FOX.
Mr. Fox, hold on one moment as the court reporter logs you in. Okay, you may proceed.
Thank you, Chairman. My name is Charles Fox, and I'm Director of Regulatory Affairs and Business Development for Bldg Energy Corporation. Bldg is a manufacturer of solid oxide fuel cells and a developer of distributed generation and microgrid projects. We appreciate the opportunity to comment today, and specifically would like to take this chance to thank both PEPCO and BG&E for the steps that they've taken to make the Maryland EmPOWER CHP program more inclusive and more technology neutral by allowing non-combustion fuel cells to compete as an eligible measure within the EmPOWER CHP program. Fuel cells are a next generation clean energy technology that's increasingly used by a wide range of customers to increase energy efficiency, secure critical facilities from the risk of grid outages, avoid energy related water use, and eliminate local combustion air pollution. In a number of jurisdictions recently, notably in Massachusetts, fuel cells have been recently included as an energy efficiency measure in utility administered energy efficiency programs. And we're very thankful that the utilities in Maryland have taken steps to propose the same for the state of Maryland. While across Maryland, combustion combined heat and power technologies are currently eligible to compete in the EmPOWER program, that's not the case for fuel cells in all of the jurisdictions. In fact, depending on where you are in the state, there are situations where the incentives for combustion CHP can be 200% higher than the incentives for non-combustion fuel cells. And the result is a market distortion where a certain customer can be presented with two different energy options, one of which gets a very significant incentive and the other which does not, and that affects their choices. We think that's really important consideration, particularly in light of recent studies, frankly, a large wave of recent studies indicating that local combustion-related air pollution is far more harmful to human health than has previously been recognized. We submitted comments for the record previously that had a list of recent studies, I think 20-odd studies, some of them with striking findings such as local air pollution can be as harmful as smoking cigarettes. The COVID-19 virus can be carried on particulate matter. In fact, local combustion air pollution has been determined to be the largest environmental health risk factor in the nation and one that disproportionately affects economically disadvantaged communities. We therefore think that in light of those new findings and in light of the distortions of the market, that we would very much like to encourage the Commission to approve the utility proposals that now include non-combustion fuel cells in the 2021-2023 EmPOWER Maryland Energy Efficiency Conservation Plans. There is one item within the utility proposals I'd like to draw your attention to and ask the Commission to review and clarify, and that is that the existing CHP program includes an across-the-board prohibition on any export of electricity to the electric grid. And there is a distinction between combustion CHP and fuel cells in an operational sense. A fuel cell is an electrochemical conversion process that has less ability to quickly alter its output in response to minor fluctuations in customer demand. And as a result, rather than a matter of economics, and I should just want to clarify that exporting power is not part of at least our fuel cell business model, but as a matter of physics, it's much more difficult for fuel cells to alter their real-time response to a customer's demand. I also want to note that Maryland law draws a distinction between combustion CHP and fuel cells when it comes to net metering. Fuel cells that are under 2,000 kilowatts are eligible to net meter. And again, we're not asking that the Commission look at this export issue as a matter of economics, but one as a technical matter and allow the incidental export of electricity where it's necessary for an otherwise cost-effective energy efficiency measure to be implemented. We therefore respectfully request that the Commission approve the EmPOWER plans, including the addition of fuel cell projects as an eligible measure in the CHP program, and in so doing, direct that the program restriction on the export of electricity be clarified consistent with state law, as well as consistent with the way that the Maryland Energy Administration administers their program. We think it's really important, in fact, that these two programs be consistent. And in fact, the Maryland Energy Administration program requires that program participants first apply to the EmPOWER program. And were this to go forward as proposed, they would have two different requirements or program rules with respect to export. So we hope they can be made consistent, and we hope that you'll see fit to approve them. And I really very much thank you for your time today.
Thank you, Mr. Fox. I may have some questions for you when we get to the question session. We'll next turn to Dandelion Energy. Good afternoon. If you could please state and spell your name for the record and then just wait a moment.
Absolutely. My name is Kathy Hanoun. That's Kathyhanun, and I am the founder and president at Dandelion Energy.
Okay. Thank you. If you could just wait one moment. Okay, you may proceed.
I have a presentation to share with you today. I'm just trying to figure out how to do that. Okay, well, I had a presentation to share with you today. Jim, do you think that you could present it? I'm not able to present it from my end.
According to our system, you have rights to present if you know how to. been transferred the rights.
Was that to me or?
Yes, to you. Kathy, you have the right to present.
It's not, my shared button is grayed out, so I'm just gonna proceed because I do not know how I can present. So let me just take it without the presentation.
Unless, I don't know if this is Jim, can Amanda potentially present it if we send it to her? I can also try if you give me control, Amanda, I can try, but this is Jim Capsis. My share button's also blanked out.
I will pass the presenter privilege to you to see if it works.
Okay, Mr. Capsis, you now have the privilege. We'll stay off the record for a moment. Mr. Capsis, you're on mute.
Turning off mute, just trying to get the right window here to share. So I'm sharing with you all the right thing, and then I'll be right there.
Right, thank you.
I'm making a very large.
Now, while we're off the record, Mr. Capsis, will you be presenting for Lenar Homes as well?
I will be.
Okay, thank you.
And all right.
Thank you, Jim.
I'm going to just go to present mode, and then you're going to be good, Kathy.
I appreciate it.
All right, how's that?
That's excellent.
Everyone see that? All right, here we go. Thank you, Chairman. I appreciate the opportunity.
No, thank you. For the court reporter, we are back on the record.
Dandelion started in 2017. We were actually a spin out of X, which is Alphabet's Innovation Lab. And in coming up with this company, our goal was really to figure out how could we use novel technology and a new business model to decrease our greenhouse gas emissions and just give consumers more choice when it came to energy. I have a background in civil engineering and computer science, and we really identified the Northeast as the region that could benefit the most from a clean heating and cooling technology. So Jim, would you mind advancing to the next slide? So the reason that we really ended up focusing on heat pumps is because heating represents a huge both fraction of spend on energy, but then also greenhouse gas emissions. So for every $1 the average American spends on gasoline for their car, they're spending another 58 cents to heat their home. And this is an average, so you can imagine in cold climates like that in Maryland, this number will be higher. And while there's so much innovation, so many companies and so much talent focused on, converting our gasoline cars to electric, there's been relatively little attention to this problem of emissions and spend on fuels in our homes. And just to put this into context, over 17%, so 17.5% of Maryland's greenhouse gas emissions come from fuel use in buildings. So it's actually like a giant chunk of emissions. And so it's a problem that really needs attention. Geothermal has the potential to reduce carbon emissions and cost of heating and cooling in Maryland by about half. So if we were able to switch pumps to heat pumps, specifically geothermal, there's just so much potential to save both money and then carbon emissions. Jim, would you mind advancing? So I thought it might be helpful to give you a little bit of a description or an explanation of what these systems are. Geothermal heating and cooling systems really consist of two parts. So you can see in this schematic of a home, there's that silver box looking thing in the basement. That's a heat pump. It sits usually where the furnace or boiler used to be and totally replaces it. So a home that uses geothermal heating and cooling doesn't require a furnace or a boiler or actually a separate air conditioner. The geothermal heat pump does both heating and cooling, and it actually also supplements the hot water used in the home. And the other part of the system is called the ground loop. So in reality, these ground loops, they're made of HDPE plastic pipe. It's the same type of pipe that is used to make milk jugs, for example. It's about 1.25 inch diameter pipe, so fairly small, but then it extends about 300 to 500 feet underground into the yard. So a very deep, though small pipe. And this pipe is circulating a fluid, which is actually a mixture of water and propylene glycol, which acts as an antifreeze. And it allows that heat pump to collect heat from the ground, to put it into the home to heat it in the winter. And then in the summer, the whole system operates in reverse. So it collects heat from the home like an air conditioner does. But unlike an air conditioner, which rejects that heat to the outdoor air, this geothermal heat pump will reject it to the ground. And the reason that this is advantageous is because the ground is always the same temperature. So when you're underground on the hottest day of the summer or the coldest day of the winter, it's about 55 degrees Fahrenheit. It doesn't really change. Unlike the air, which obviously does change substantially over the course of the year. So think about the hottest day of the year. This is when every air conditioner is running at full capacity. It's actually every air conditioner is operating at its least efficiency because it's very difficult energy-wise to move heat from the indoor of a house into like 105 degree outdoor summer air. It requires much less energy to move that heat into the relatively cool 55 degree ground. And that is why geothermal heat pumps can be about 500% efficient. It sounds physically impossible, but the reason they have these efficiencies that are so high above 100% is because for every 1 unit of electricity that you use to run the system, you're collecting about 5 units of just free renewable geothermal energy from the ground and moving it into the house. So let's go to the next slide. Though the company was born at Alphabet's X Lab in California, we knew right away that it made sense to start this company in the Northeast because this is where we experience hot summers and cold winters. This is where so much of the spend and the emissions are coming from heating. And we specifically decided to start the company in New York because the incentive structures there in the utilities allowed us to make this value proposition really attractive to our customers, which are just homeowners. I wanted to explain this dollars per ton unit at the header of the column. So we measure the heating capacity of these systems in tons. A typical home, so the most common type of system we sell is 5 tons. So you can just look at the right-hand column, the total for a 5-ton system, to give you a sense of the total rebate amount a typical homeowner will receive from their utility for a geothermal heating and cooling system. So you can see in New York, this incentive on the high end with Con Edison is $14,250 for a homeowner in that territory. And then on the lower end in New York, and what is now true in Connecticut, it's around $7,500. And this incentive allows homeowners to switch to geothermal and actually be better off economically for doing so. So it's allowed for very rapid uptake of these systems in New York and now Connecticut, which we recently moved into when they introduced this incentive. Just to show you sort of the state of the incentive with Maryland's utilities today, it's not a per ton incentive, it's just a total incentive of $1,500, which today is too low to allow for that scale of adoption, which is why we haven't yet entered Maryland. So could we please go to the next slide?
And Ms. Hanoun, if you could allot for about 5 more minutes.
Yes.
Thank you.
Absolutely. So our recommendations, and this is my last slide, and then I'd be happy to take any questions. So our recommendations for making Maryland a great market for scaling geothermal for residential customers here is to establish a residential new construction incentive of $1,250 per ton. And this would allow new homes that are going up not to put in fossil systems, which will be there for decades, but to really create new building stock that already is equipped with renewable heating. We also recommend revising the existing geothermal heat pump incentive from $1,500 per total per project to $2,000 per ton, which would put it sort of in the middle of the New York incentive regime. And lastly, we recommend allowing all fuel and carbon savings to be counted in cost effectiveness tests. I'll close by saying thank you just for this group's leadership on energy efficiency, and I would be very excited to have the opportunity to bring scaled residential geothermal to Maryland. I think it could be an amazing opportunity to just give customers a better choice that also decreases greenhouse gas emissions in Maryland.
Thank you very much. I know we have some additional speakers on geothermal technology, so if you could stick around, the commissioners may have questions for you. At this time, we'll turn to Geller Lighting Supply Company. And if the representative could please state and spell your name.
Hi, this is Edison Geller, EDISONGELLER. I'm one of the principals here at Geller Lighting Supply, and we were...
Sir?
Yes.
If you could wait a moment for the court reporter to log you into the system.
Absolutely.
And if you have a camera on, if you wanted to turn that on.
Oh, my apologies. I didn't realize I didn't turn it on.
There you go. And you may proceed when you're ready, sir.
Okay. Sorry, I apologize for this phone. Yes, thank you for having us. We are here at Geller Lighting Supply. We're a local lighting supply house. We've been around since the 80s. We've been participating in the EmPOWER Maryland rebate programs for lighting since 2008. And since 2008, we've seen the products transform through the industry, which thankfully the power companies have adapted with and changed their programs in order to maintain the latest and greatest lighting technologies. We participate in the program for BGE, PEPCO, Delmarva, SMECO, and we're also in DC's PEPCO program that's hosted by DC SEU. A few things I wanted to talk about today was regarding the BGE programs and the changes that they're making to the program. And what we like and what we see from both programs. The programs are the midstream programs for lighting products for commercial applications only, not residential. And what we see from the PEPCO and Delmarva program is their adoption of both Type B lighting technologies along with lighting fixtures and mainly LED technology. The Type B lighting technology that PEPCO and Delmarva has are tubes that replace the fluorescent tubes, and also corn lamps that we like to call them because they look like a corn cob, but they replace the HID lamps, which you might see in parking lots, on wall packs and whatnot. BG has been a little hesitant to adopt these products because they do require some labor in order to install them. They're not per se plug and play. However, many of our customers are capable of performing these modifications to their fixtures in order to be able to use these Type B technologies. Delmarva has adopted over the past year fixtures such as flat panels, which replace the grid fixtures like you might have above you in your office. They have wall packs, which you might see on the outside of buildings, the lights that light up your parking lot. And these having these products on the midstream program really opened up a huge wave of customers that have been using the program to purchase these more efficient lighting technologies, opposed to spending less money and getting a less efficient product, but that meets their budget. So the fixture program for Delmarva really has been going well over the past year, and we're excited that BG is proposing that, and ICF is proposing that to the commission to bring forward to the BG programs. So between the fixtures and the Type B tubes and also Type B corona lamps, there are a lot of beneficial lighting technologies that were proposed to the program in front of you. But all in all, it's the products are great. They really are they really make it easy for the customers to upgrade their lighting in order to have a safer exterior environment, and along with using less energy to all in all help help the state out with reducing the energy consumption. But yeah, I don't know if you might have any questions regarding the lighting technology. I work with the lights every day, so some of the words I may have said may have been over your head. Is there anything that you were unaware of, or anything I could explain a little better to you?
Taylor, we may have some questions for you after we get through the initial list of the presenters. So if you could stick around for the next half hour or so, the commissioners may have questions.
Yes, absolutely. And we're very excited to move forward with the program, and we we work hard every day to stay up to date on the latest technology, and we meet with ICF regularly to discuss what's new in the market, what's phasing out, and so we could all stay on top of things and really present the best products to our commercial customers here in Baltimore and throughout the rest of the state of Maryland.
Thank you very much for your comments.
Thank you for having us today.
At this time, we'll turn to the representative from the Maryland Geothermal Association.
Good afternoon. My name is Adam, A-D-A-M, Santry.
If you could just pause for one moment. You may proceed.
Good afternoon, and thank you for the opportunity to provide comments today. My name is Adam Santry, and I'm the president of the Maryland Geothermal Association, as well as the president of Allied Well Drilling, which is a Maryland-based drilling company. Allied Well Drilling is one of the top geothermal drillers in the country, and we employ more than 100 well drillers and associated employees in the area. We mostly do business in the Northeast and Mid-Atlantic, and are headquartered in Anne Arundel County, Maryland. Although most of our work has been shifted out of state the last few years, as we'll talk about here in a little bit. I'm here today on behalf of the Maryland Geothermal Association, which represents over 30 residential and commercial well drillers, 100 heating and air conditioning contractors, as well as manufacturers, and the Maryland Delaware Water Well Association. We're here to voice our full support for the 3 recommendations that were made earlier by Dandelion. Number 1, to establish per ton incentives for new construction of $1,250 per ton, as Dandelion outlined earlier. To revise the existing geothermal heat pump incentive from $1,500 per project to $2,000 per ton for the highest efficiency equipment, and also to allow all fuel and carbon savings to be included in cost benefit tests. We feel these recommendations would help the geothermal industry in Maryland be more regionally competitive, as you saw in some of the previous slides, create high-paying jobs both for the water well drillers, geothermal drillers, as well as HVAC contractors in the state, and also to help us meet our ambitious energy efficiency and climate goals. I'd like to provide a little additional information on the potential of the geothermal industry in Maryland and what some of these proposed changes could mean for us. So geothermal jobs, what are they? I think Dandelion did a great job outlining a minute ago of how the system works. So geothermal energy jobs are very high in labor. It's a very high labor and high capital intensive industry that'll create a lot of high pay in Maryland. And the reason is these systems are built on. In that picture and diagram you saw earlier, you have to picture it's multiple wells, multiple infrastructure piping that all has to be brought to site and built and assembled in the ground at the project in Maryland. This isn't something that can be outsourced out of state. It has to be done by licensed tradesmen through the state of Maryland. It's licensed well drillers. It's licensed heating and air conditioning contractors. Everything's permitted currently through the Maryland Department of Environment, which we feel is very key. These jobs are high skill, high tech, and high wage. Your typical geothermal well driller is making anywhere between $75,000 to $120,000 per year to perform this work. There's also many part-time geothermal companies that are currently offering this that serve as our well drillers, our HVAC installers, or our oil and gas professionals, as there's a lot of different overlap in some of these industries that we'll be able to bring in to help supplement the geothermal industry. In the case of many well drillers, geothermal installers are what are helping keep their companies in business right now. Over the last 10 to 20 years, we've seen a loss in a lot of new water well developments, and that's put a tremendous strain on the drilling industry. And I know my company, I can speak for us, that's been supplemented by geothermal. That's what's enabled us to continue to hire local Maryland employees and continue to grow our business. That strain has been felt in providing infrastructure to a lot of existing water well customers. There's parts of the state right now where people are waiting 12 weeks to get water at their homes if their well ran dry because the local driller is no longer in business. These are all jobs that we could bring into the geothermal industry, save the companies that are out there now, and actually to grow that industry in a geothermal capacity and to help us provide really needed infrastructure on the water side. The Maryland-based companies that are providing geothermal, like myself now, a lot of us are working predominantly out of state for geothermal projects. We're going to places like New York, Connecticut, South Carolina, places that offer better incentives. We feel that if a lot of these proposed changes were made, we could bring a lot of our Maryland people home, back to where they live, instead of having to constantly be sending them out of state on projects. As a side note, one of our members is actually Water Furnace, which is the largest maker of heat pump equipment. And we were sad to see that they actually dropped their territory rep for the state of Maryland. We actually lost them to New York. We actually haven't had a rep in the last 2 years here in the state, where 10 years ago Maryland was a real leader in geothermal. What are some of the market barriers with geothermal? Maryland's long been a leader in energy efficiency and clean energy, but it's kind of fallen behind in geothermal. The main barrier for widespread geothermal adoption is upfront system costs and the absence of third-party financing. And that third-party financing kind of goes hand in hand, right? A lot of times that's based on the rebates that are offered or your state incentives. We feel that increased incentives would help open up the market to lower and middle income homes and drive the kind of customer adoption and innovation we've seen with solar throughout the state. And as I mentioned before, it would also help create more high-paying jobs and help attract and retain skilled laborers in the drilling industry and HVAC industry in our state. So in closing, I'd also like to mention that we appreciated the comments by the Maryland Energy Efficiency Alliance in broad support of heat pumps as a central tool for building electrification and reducing carbon, and that we feel that adopting those 3 proposed recommendations would greatly accelerate the growth of geothermal in the state and really help make this affordable technology in our state for homeowners, help them reduce their carbon footprint, and help them lower their home heating and cooling costs. So I appreciate your guys' time today. Thank you.
Great. Thank you for your testimony as well as your joint comments with the Maryland-Delaware Water Well Association. At this point, we'll turn to comments from Lenar Homes and Mr. Kapsis again.
Thank you, Mr. Chairman. My name is Jim, J-I-M, Kapsis, K as in kite, A, P as in Peter, S-I-S.
Thank you. Just one moment, please. Okay, you may proceed.
Thank you, Mr. Chairman, commissioners, and staff for the opportunity to speak today. My name is Jim Kapsis. I'm the CEO of the Ad Hoc Group, a firm that advises climate tech and sustainability-focused businesses. I was previously the Vice President of Regulatory Affairs at OPOWER and a former U.S. Treasury official working on energy and climate finance. My firm advises Dandelion, the Maryland Geothermal Association, and Lenar Homes. Today, I'll be speaking on behalf of Lenar. As you may know, Lenar is headquartered in Miami, Florida, and is one of the country's leading home builders, doing business in 21 states, including the state of Maryland. Each year, Lenar is building around 50,000 new homes nationally, of which more than 1,000 are built here in Maryland every year. Lenar is very focused on leading the way in environmentally friendly technologies that are designed to reduce both the carbon footprint of the home, as well as making home ownership more affordable for everyday working Americans. I'm proud to say that today, every one of Lenar's new homes in Maryland takes advantage of the incentives from the EmPOWER Maryland residential new construction program. Maryland is a leader, and we're meeting Maryland as sort of where those incentives are to make our buildings, our homes, that much more efficient. I'm here today because we do see incredible potential in the future of geothermal heating and cooling as a clean, efficient, and electrified solution for homeowners. This is consistent, I think, as Adam mentioned before, with the Maryland Energy Efficiency Alliance's comments, which stress the important role that heat pumps can play in electrifying the state's building stock and reducing emissions. For our part, Lenar estimates that installing geothermal heat pumps in our homes would decrease our HERS rating by 6 points or more and get our homes more than 50% below the energy use of a standard new home. That said, and that's the direction that we do want to go, the current barrier for Lenar to implement these systems really are, as you've heard today, the upfront costs. Maryland is really progressive when it comes to building codes. I mean, really after California, it is sort of a model on building codes, but really without additional incentives, the market just is not competitive with other leading states in our region. And for us, the dollars just don't pencil out right now to include geothermal heat pumps in our new homes. But we do believe that with the right incentives, we would be able to, as quickly as next year, 2021, begin installing geothermal systems here in Maryland with the goal of doing so at scale over time. We respectfully encourage the commission, echoing some of what you heard before, to adopt Dandelion's proposal to establish, in particular, a $1,250 per ton incentive for new construction, and for that incentive to be available directly to the builder, consistent with current new construction incentives. We believe these incentives would, one, meaningfully grow the geothermal market in Maryland, two, make geothermal the heating and cooling choice for Lenar, as well as for other builders in the state, and really provide a model, as Maryland has been for so many other technologies in the clean energy sector, for other states to follow to achieve their climate and energy efficiency goals. Thank you for your time and your consideration of these recommendations, and look forward to your questions later in this discussion.
Thank you, Mr. Kapsis. We'll now turn to Mr. Sam Jamal. If you could please state and spell your name.
Thank you. Sam Jamal, my first name S-A-M, last name J-A-M-M-A-L. I'm with the Ceres Energy Optimization Work Group.
Okay, if you could pause right there. The court reporter needs to log you in.
Sure.
Thank you. Okay, you may proceed. If you could state your affiliation again. Thank you.
Yes, sure. Sam Jamal with the Ceres, C-E-R-E-S, Energy Optimization Work Group. It's a national nonprofit that runs a business coalition of manufacturers and different businesses that operate in the energy efficiency and energy optimization space. We have a whole host of companies that we work with who like to engage in state processes that are affecting these policies. And so first, I want to thank you all for your leadership in moving forward in the EmPOWER Maryland programs, and for just the different filings and the consistency of making sure these programs are funded. From our end, we were able to build out a coalition of 19 companies that we filed a letter into the record for, highlighting just this overall business support, because there's a broad economic opportunity here, both from the customer side to have savings through energy efficiency, as well as the job when you get to put people back to work to do these sort of projects. And so for us, really want to just thank you all for leadership and highlight that point that energy efficiency helps the state manage its load, but also helps create jobs and helps consumers save money. In particular, as you do look at these programs, we would ask that you explore expanding financing options available to commercial customers. The need for financing has increased due to the COVID-19 pandemic and the economic recession. We believe the Commission should expand low and no cost financing options to support installation of energy efficiency technologies and equipment. We also believe that you should look into expanding the eligibility threshold for customers participating in small business energy efficiency programs. The current eligibility limit is 60 kilowatts, which severely limits program participation for small to medium-sized businesses. We recommend that this threshold be increased to 150 kilowatts as proposed by Potomac Edison, Pepco, Southern Maryland Electric Cooperative, and Delmarva Power and Light to allow for more small business participation. Just to highlight from our letter, I'll just list out the companies that signed on to the letter and are engaged in watching and really, supportive of these efforts. 2G Energy Inc., AB Energy USA, Capstone Turbine Corporation, Carter Machinery, Combined Heat and Power Alliance, Cree Lighting, Curtis Power Solutions, DT Energy Consultants, Efinity Distributed Generation, Energy Management Solutions Inc., Canaan Energy, National Association of Energy Service Companies, NAESCO, Schneider Electric, Sheet Metal and Air Conditioning Contractors Associations, Maryland Chapter, Turbine Inlet Cooling Association, Unison Energy, Uplight, Washington Gas, and Willdan. And so we'll be closely watching any way that our businesses can help, educate you on some of the projects we're working on or ways to make sure that the financing is available and accessible. We're more than happy to do so, but really just wanted to come here and thank you for your leadership and just show our support for the EmPOWER programs. Thank you.
Thank you, Mr. Jamal. We did receive your comment. Just a point of order. You stated Washington Gas. Is that Washington Gas the utility or a different Washington Gas?
It looks like it's actually the utility. Yes.
Okay. Thank you. Oh, yes. Their logo is on your letterhead with.
Yes.
Okay. Thank you, Mr. Jamal.
Thank you.
We'll next turn to Mr. Bobby Height.
How are you doing?
Hi, you are on. If you could just state your name and spell it and then pause.
I'm going to pause the video. I'm sorry. I have 2 small children still on in class, so bandwidth is a little limited in the home.
Understood.
My name is Bobby Height, BBYHIGHT.
Just one moment, please. Okay, you may proceed.
Okay. So I'm testifying today on behalf of the Maryland Building Performance Association, the MDBPA, where I serve as vice president. MDBPA is a nonprofit trade association serving Maryland's residential energy efficiency and weatherization industry. MDBPA has 70 member companies representing approximately 1,050 employees across the state who are Maryland's homes and buildings more efficient, healthy, safe, and resilient. Our members include home performance and weatherization contractors, as well as companies providing HVAC, insulation, lighting, and other building performance services. My background is I'm the owner and operator of a Building Performance Institute training and test center, as well as a home performance weatherization company working in the BGE and Pepco Home Performance with Energy Star programs, as well as the SMECO HEIP program. I would like to thank the commission today in more ways than one for allowing me to speak. 12 years ago, I was actually a fireplace installer, and through training dollars provided by the commission, I was able to cross-train from an industry that was sort of going down the dark to an industry that was up and coming and have the ability to stand before you and speak today. So on behalf of the board, we are very happy with the current service and structure of the existing programs, and we would like to give our blessing for what is recommended going forward. But as per the finance work group, we urge the commission to implement an affordable financing program in the short term. Under the circumstances of COVID, affordable financing is more critical than before. We seek financing that will achieve the following: that will provide attractive, low-cost financing to our customers, save on financing costs and therefore overall job costs, complete larger projects inclusive of more measures and deeper energy retrofits, and ultimately to sell more jobs and therefore increase energy savings across the state. We have worked with MCEC and the Maryland Home Energy Loan Program and see their proposal as the most viable for our industry. Our contractors successfully participated in this program and welcome the opportunity to take advantage of easy-to-use, affordable financing once again. Thank you.
Thank you, Mr. Height. If you were with us yesterday, you heard that discussion with the Finance Work Group report. At this time, let me inquire if there are other parties that were not on my list that would like an opportunity to speak today. And this is for the general public or members of particular industries. Okay. Hearing no takers, obviously we've heard from a lot of segments today from the lighting sector, geothermal, fuel cell, HVAC, and other interests. I'll have one question to start for Mr. Fox. Mr. Fox, if you're still with us. I recognize that some of our utilities are going to be or have proposed including fuel cell technology in their next 3-year program. You cited numerous times to the prohibition on the incidental export of electricity. Can you explain where that provision or prohibition exists?
Mr. Chairman, I'll have to get a page number for you, but in the EmPOWER program proposal before you, in the CHP section, there's a sentence or two that simply say the program prohibits the export of power. We read that to mean any export of power, and really are just trying to draw a distinction to say that these two technologies are not precisely the same in the way that they operate, and that if required in terms of the physical operation of a project rather than as a revenue earning measure, that it ought to be allowed for fuel cells, in large part because the Maryland law already says that fuel cells are allowed to export under the net metering law. But I can certainly get you a citation to the program proposal. I'm sorry, I don't have that.
That's not necessary. However, if there is a prohibition in state law, how is the commission to make an exception to that?
I want to be clear there isn't a prohibition in state law, that there is a requirement in state law that fuel cells be able to net meter as long as they're below 2,000 kilowatts. So what we're arguing is that the program proposal should be made consistent with state law. It's currently consistent with state law as applied to combustion CHP, but inconsistent with state law as applied to fuel cells.
I'm still having trouble. If it's inconsistent with state law, what is the authority of this commission to effectively overrule the law?
I think let me clarify, Mr. Chairman. What I'm suggesting is that the proposal before you, as it relates to combustion CHP, which is what it was written for, is consistent with state law, and not suggesting it should be changed. However, by including fuel cells and applying that same prohibition to it, it becomes inconsistent with state law, because fuel cells, but not CHP, are allowed and permitted to net meter. So the proposal bans the export, but the law permits the export only with respect to fuel cells.
And when you say the proposal bans the export, are you saying the utilities proposal?
Yeah, and I want, yes, but I want to say that in a very non-critical way. The existing program was designed for CHP and written for CHP. And this is not a change. They simply stuck fuel cells into the CHP program, and that requirement was already there. And we're simply pointing out that a careful review of that would reveal that I think is an inconsistency with the law.
Okay, thank you. I need to spend more time with this to better understand
Sure.
the consistency. I appreciate that, Mr. Fox.
Thank you, Chairman.
I'll see if other commissioners at this point, I may have some for some additional speakers. Other questions from commissioners? I will ask the geothermal.
Sorry, Mr. Chairman, I did.
Oh, okay. I'm sorry. Go ahead, Commissioner Harman.
Oh, okay. Sorry, I was pushing the wrong buttons. So I know that Mr. Jamal and I believe I think there was other commenters talking about expanding the small business participation to 150 kW. Do you have a sense of what kind of businesses we would add in if we expanded to 150 kW? kWh? Did we lose Mr. Jamal? That's okay. I can ask the utilities. Go ahead, Commissioner Linton.
Mr. Chairman, excuse me, Commissioner Urban. I had a similar question, but I also had an additional question for Mr. Santry or perhaps even Ms. Hanoun from Dandelion Energy. There was a suggestion made that Maryland at one point had a leadership position in geothermal energy, but over the course of the last 10 years, we've kind of lost a step in comparison to other states. And I'm curious as to your thoughts on what happened and why is it that was it that other states did more within the last 10 years, or did Maryland do something to prohibit continued growth of the industry here?
If you want, I can jump in here, Kathy, or you can. A little of both, to be frank with you. Other states, as you can see, have really ramped up their participation. And geothermal, compared with other technologies, we've either stayed flat or in some cases it's actually gone down. For example, there were a lot of counties in years past that offered a $5,000 property tax credit. That's went away. Just a lot of the programs that have been offered through the state, through MEA. Sorry, I'm getting a little bit of background in my earpiece. I apologize. Have gone away as well. We've ran out of money on the grant program a number of times through the state. And, so I think it's a factor of the two. It's a factor of some of the existing programs in Maryland have actually stopped and other states have continued to push forward. And then, so when you look at our place in the current marketplace, in the green renewables, other industries continue to, move forward where we're, at the best we were flat. And in some cases, no, it's actually taken a step back.
Justin, that there were multiple initiatives in Maryland that all appear to expire around the same time. Is there a reason for that, or is this just coincidence?
I think it's just coincidence. It's been a bit of a. It wasn't all at once that it all happened one day. In the last few years, we were making momentum 10 years ago. And that momentum, as far as the geothermal industry, it has really slowed in the last, 6-8 years, I'd say.
Yes. Last question: what is the applicability of geothermal solutions to homeowners that may not, or even I'll stick with homeowners who may not have the amount of land necessary to have that kind of solution installed in their home. So I'm specifically thinking about low-income customers, for example, that may have a smaller property footprint.
I'll let Kathy go, but one thing that I think is the beauty of geothermal, whether it's townhouses, under buildings, under driveways, there's always room. If you're familiar with the new Montgomery County headquarters where they were redeveloping Wheaton, there is a geothermal system supporting that whole high-rise building. It's underneath the building. So low-income housing is an ideal solution for it. In Washington, D.C., we're doing a tremendous amount for all the new low-income down there, and that's just something that we're not seeing take place in Baltimore. We have a couple in Prince George's County and in Glen Burnie and Arundel County that, I'd be happy to ever walk anyone through. But the space, because we're drilling straight vertical, we don't need a lot of land because we're going straight down and it can be underneath anything. There's actually geothermal on a lot of very, very small properties. The thing with geo is you don't even know it's there because there is no panel. You might not even know if a residence or house or building actually had geothermal on it.
I think you explained that really well, Adam. And the only thing I'll add is another thing that we've been doing to make geothermal affordable to low-income homeowners is we've added financing. So, we have customers that switch to geothermal not for the, an environmental benefit, but simply because their monthly payment to pay for geothermal energy is less than what they used to be paying for fuel oil. So the economic interest of the customer is aligned to societal interest, which is one thing that is so motivating about the technology.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Commissioner. Do we have additional questions for this panel? Very interesting perspectives from a wide array of stakeholders. Well, I want to thank all these members of the public. Oh, Commissioner O'Donnell.
I had sent you a request. I don't know if you saw.
Oh, sorry about that. You did, Commissioner. If you could lean forward or speak a little higher, we're having an issue. Thank you.
All right. Mr. Nan? Kathy? I'm sorry, I must have got your last name incorrect. What is the approximate cost of a 5-ton geothermal heat pump?
Yeah, so as I was mentioning, we offer financing or paying upfront to our customers. So let me tell you the cost in each of those situations. About half of our customers choose each one. So for the customers that choose to finance, they pay nothing upfront and they pay approximately on average $135 a month over the course of the system lifetime. So it's a 20-year loan. And for the homeowners that choose to pay upfront, it's approximately $20,000, though it really depends on the home.
And is that just the pump, it's the heat pump itself, or is that the installation, the drilling, the whole 9 yards?
Thank you for clarifying. So I'm talking about the all-in cost. So the way we sell it is, soup to nuts, like we'll take care of everything, design, permitting, drilling, the heat pump equipment, just like the whole thing, so that the homeowner doesn't have to manage the project themselves. So that's the all-in cost.
I appreciated your little diagram. It's something cool. The way I used to explain how a nuclear power plant works, right?
I'm glad to hear it. Thank you.
But the piece that goes in the house from the pump, how is that interfaced with the air? How does that technology work?
Yeah. So, there are different types of geothermal heat pumps. The type that Dandelion installs, it's a forced air system. So it interfaces with the ductwork in the home in the same way that a furnace would. The plenum of the ductwork is just connected to the heat pump, but companies also make water-to-water systems that can be retrofitted into radiator-based distribution systems or hydronic systems. So the way it connects to the distribution system is very similar to a traditional heating and cooling system.
Okay, thank you very much. I was wondering if there was still an air handler involved in the system. So I appreciate it.
Yeah, there is.
Thank you. I appreciate it. Thank you, Mr. Chairman.
Thank you, Commissioner. If there are no additional questions from commissioners this afternoon, I'd like to thank all the participants for submitting comments, both in written form and for their testimony this afternoon. This will conclude day 2 of our EmPOWER hearings. Day 3 will begin tomorrow, October 28th at 10 a.m. Eastern. With that, today's hearing is adjourned. Have a good day. We're off the record.